Lindsay, on the economy, are we rolling over or re-accelerating?
Well, I think it's difficult to say, but from an inflationary standpoint, the risk is certainly to the upside, with the latest data far from convincing that we are on a sustainable pathway back to 2%. Remember, the Fed raises rates in order to slow the economy and arguably to break the consumer. But with the economy accelerating into the year end and the consumer still very resilient, it's not yet clear that the Fed has done enough to ensure that the U.S. economy gets back to a place of price stability.
When you say done enough, do you mean they need to go higher or just hold where we are for even longer?
Well, I would argue that the Fed does need to raise rates higher, but at this point, the committee has capitulated that 5.5% is the terminal level. That is sufficiently restrictive according to their models. So I do think at this point, the Fed is more likely to simply remain on the sidelines, keeping rates higher for longer rather than re-engaging in further rate hikes. But again, I'm not convinced that this is the right level for the Fed funds rate in order to get us back, ensure that we get back to price stability.
Lindsay, what are you looking at in particular? Because this really goes against what we heard from Mohamed El-Arian, who was speaking on Friday with John and Anne-Marie, and other people who say there is weakness. It is coming. We just haven't seen it quite yet.
Well, we're seeing a loss of momentum, certainly. When we look at 3.3% GDP, well above expectations in terms of year-end growth, but that is a loss from a near 5% acceleration in the third quarter. The consumer, when looking at personal consumption expenditures, down slightly. And when we look at the momentum of business expenditures, also beginning to slow. But looking out to 2024, that doesn't necessarily mean that we're going to see a material slowdown or force the economy into recessionary territory. Slower growth, a loss of momentum, absolutely. But we are looking for still a maintenance of around 2-ish% GDP over the course of 2024.
One thing that an increasing number of analysts are pointing to are credit card delinquencies. And RBC Capital's Michael Tran came out with a model that showed that they expect to see a large increase in quarter-over-quarter credit card delinquencies in the second quarter of this year. With the new predictions, that basically brings us to 9 consecutive increases in delinquencies, which is 6 more than the previous record. And Lindsay, a lot of people are saying this is the early sign of stress in consumers that will show up increasingly in data. Do you agree with that?
Well, we have seen an uptick in delinquencies, absolutely. And it's not to say, even with this resilience in part of the consumer, that households aren't feeling the pressure of higher borrowing costs, of higher prices, of the resumption of student loan payments. Absolutely, they are. But we're also seeing some organic offsets to that pressure and to the loss of more recent fiscal stimulus and pandemic savings, because we're starting to see decent gains in wages. Real wages turned positive at the start of last year, and that's continuing to gain momentum as we move further into 2024. So the consumer is under pressure, absolutely, and they are turning to credit cards. We have an outstanding balance of over $1.1 trillion. But we also have to put that in context of the health of the household balance sheet. Because during the pandemic, we weren't just buying Pelotons, we were also paying down credit card debt. So while I'm certainly not advocating for the consumer to take on more credit card debt, the balance sheet does have additional wiggle room. We can continue to grow the liability side of the household balance sheet, at least for some time longer, before it becomes that traditional red flag. So we are seeing some pressure, but there's still some room of resilience for the consumer to continue as we move further into 2024 and beyond.
Lindsay, let's just sit on that. You believe there's space for the consumer to lever up. With that in mind, are we still really underestimating the potential for US growth this year?
I don't necessarily think so, because again, there still is that second derivative decline, that loss of momentum. And when we look at the consumer, still able to take on new amounts of debt, but under pressure of higher prices, higher borrowing costs, that translates into still positive, but a loss of momentum from what we saw earlier. So that looks like about a 2 to 2.5% average growth rate over the next 12 to 18 months.
I wanted your thoughts as well on a policy conversation, a discussion set to take place at a March meeting at the Federal Reserve. Chairman Powell already flagged it in the news conference. It's going to be on the balance sheet and on QT. What do you think informs their decision of what to do with the balance sheet and the pace of QT?
Well, again, the Fed is beginning to open the door for a change in policy. Not only are they shifting that door further open for eventual rate cuts, but they said that they're going to start the conversation about the conversation for ending QT, or at least revising QT. But all of that is going to depend on the evolution of the data. The Fed is in no rush to remove the firming, the policy firming that they've put in place over the past 2 years. And unless the data comes in extremely convincing, unless the data comes in showing that acceleration in disinflation, I think the conversation, not only for rate cuts, but for the balance sheet, is going to be just that, a conversation without much action taking place until at least the second half of the year.
How concerned are you about a long-term government shutdown impacting economic growth? And I say this not just because of the government shutdown that could take place, but also what this might mean for Moody's, who put the United States on negative watch because of political polarization.
Well, I think we've seen this story play out before, and the biggest impact is going to be on confidence. And I don't think it's going to be enough to significantly move the needle in terms of top-line growth, nor is it enough to significantly move the needle in terms of the longer-run pathway that the Fed intends to be on in terms of adjusting policy. But in the near term, absolutely, the ongoing shenanigans in Washington certainly play on confidence, could lead to an additional downgrade, and undermines the confidence the international market has in terms of looking at the U.S. market as a flight to safety trade, a quality trade, as we've seen before, again, as this storyline has played out.
To build on what Anna Marie was talking about, we get $63 billion of two-year notes sold today, $64 billion of 5-year notes sold today. We have $42 billion of 7-year notes tomorrow. When are we going to see some of these concerns about government misfunction in the auctions that have proven a headwind to economic trajectories?
Well, it's interesting because we did seem to have somewhat of a wake-up call back in October. If you remember, the 10-year skyrocketing to near 5%. But once the Fed began the notion of potentially cutting rates, concerns of government deficits, a bloated government balance sheet, fell to the wayside. But you're right, regardless of whether or not it's the topic du jour, deficits do matter. Debt does matter, as it will continue to beget more debt and readjust, I think, the market's longer-term expectation for rates, or at least provide a floor, particularly to longer-term rates, as Treasury issuance is expected to increase between 23 to 25% up and down the curve in order to finance this bloated government spending. So again, I would argue that we should have seen a reaction in the market long ago. But for some reason, investors at this point are still very focused on the notion that the Fed is going to initiate the process of rate cuts. And when they do, that process is going to be quite accelerated, bringing us down to a much easier level of credit conditions. But I think the market, as we've seen before, has been wrong in terms of their timing for the Fed to end rate hikes, and is again going to be incorrect in their assessment of not only the timing for the first rate cut, but that more tempered process on the way down.
Interesting. Lindsay, appreciate the argument. Lindsay Piegser there of Stifel. I want to go through those numbers that Lisa just ran through again. $63 billion of 2-year notes, $64 billion of 5-year notes, tomorrow $42 billion of 7-year notes. That's real money.
Especially because there's also real money of debt sales from investment-grade corporations coming out at the same time. Does it start to test the appetite of people who've already sucked up a lot of this debt so far this year?
Yep.
I don't know. Watch the auctions.
More of those numbers in just a moment. Coming up in the next hour, Michael Schall of Market Field Asset Management, Ed Mills of Raymond James, and Subhadra Japa of SocGen from New York City. This is Bloomberg.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
We're operating in a very volatile environment. So JetBlue has a very large presence here in New York, and there are air traffic control challenges. And so we've had to overinvest in hiring excess crew members and building flexibility into our planning process. And so over time, we hope to wean some of those investments back as the operating environment around us stabilizes.
We made the decision early on that we were only going to invest internally on key differentiating technologies, and clearly the powertrain is the key differentiating technology. So our investment is a recurring investment with respect to the powertrain team, the battery team, which is part of it, the engine team, electric engine team, which is part of it. And we also have a lot of non-recurring costs with the other components.
From the UK, and I'm the inventor of the gel razor, and today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel, hence I developed the all-in-one. The idea is you pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision, that's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
The market has not been very sensitive to what the Fed has done.
At this stage of the game, just like the Fed, we're waiting for more data to try to assess what they're thinking.
Right now, financial conditions look to be on an easing trend, right? So what is the rush?
The longer that these policy rates stay elevated, the more that they're going to bite into the economy.
If they don't cut in June, then you'll hear me say, oh no.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Lisa Abramowitz, together with Anne-Marie Hordern. I'm Jonathan Ferro. Your equity market on the S&P 500 just about unchanged after closing at all-time highs in Friday's session. Lots of talk about NVIDIA, not much talk about jobless claims. Jobless claims in and around 200K. And once again last week, for the fourth week, two-year yields climbed higher. Your two-year this morning, just short of 470. Lisa, jobless claims is going to be a bigger conversation this week, going into payrolls next week.
You raise a fascinating implicit question here, which is why are stock markets not responding more to the apparent strength in the U.S. economy that is inflationary? It is not the immaculate disinflation that so many people were talking about for so long. If you truly have that, do you have reinflation? Well, maybe not. But do you have stickier inflation that changes policy over a longer term? That's the question, and the ramifications unclear.
You can make the argument that the index is not responding to the repricing in rates because it's insulated by one single name, NVIDIA. Can you make the same argument for small caps? Probably not. For regional banks, definitely not. So far this year, those rate-sensitive parts of the equity market are still hurting from what's happening at the front end of the curve.
This is the difficulty for me, is that we can't talk about any sector as a monolith, because within the Russell 2000, you've got cruise liners that are crushing it. You have other kinds of consumer discretionary companies that are absolutely hammering home incredible results. And then you have regional banks that are getting crushed. And then you have others that are getting crushed, that are more indebted and have that interest rate sensitivity. It's a tough market right now. It's really tough to sound smart. There's really nothing that people can say. When people do try to sound smart, they kind of get blown out of the water.
You could be right or sound smart.
Exactly.
For the second time this morning. Maybe those regional banks need to produce Icon of the Seas. Icon of the Seas. How much is Icon of the Seas? That boat's ridiculous.
It's ridiculous, but maybe they're going to offer free rides on Icon of the Seas to get deposits. Last week, we found out the toaster might be coming back, or maybe it's the bobblehead.
Yes.
Yeah, because they need to attract the money that Icon of the Seas just mints, because people want to be on a floating.
They were promising me all kind of things to deposit cash at those regional banks. I'll take that $5 from AT&T. and push it over to a regional lender. Should we do that?
Really?
Just to help out and contribute, Ramo, just to help out and contribute.
Are you excited about that $5?
Which one, the $5 thing? Look, I think it's expensive for them. It's not going to make a difference for a lot of people.
Exactly. Why not just invest it in making sure that you don't have some sort of, what do they call it again? I mean, what kind of explanation? Processing malfunction? What does that mean?
It's going to cost them almost more than $400,000. I mean, that's about $500,000.
It's going to cost way more than that. It's going to cost a lot more than that.
Well, when they try to figure out what the problem was and then make sure that their infrastructure is
I
up
wonder
to
if
par.
you call them directly, whether you can get more than $5 from them. I wonder if you could get like 10, 15 if you really called them and complained. I used to complain a lot. I don't anymore. But I think if you do call directly, you can usually do a lot better than the first offer.
Joint surveillance tomorrow. Jonathan Ferro reporting.
I'll call them live.
Just what
We'll put it on speakerphone.
It'll be fantastic.
I'm not going to do that at all. Wanted to mention these numbers, go over them again. Lisa's mentioned them a few times. I think it's worth going over. 2-year notes coming later, $63 billion worth from the Treasury, $64 billion of 5-year notes coming later as well. Tomorrow, 7-year note. That auction, $42 billion worth. So we talk a lot about dysfunction in DC. They're good at one thing, increasing the debt by a lot.
They certainly are. And potentially we'll see more of that this week because tomorrow there's going to be a big meeting at the White House. Schumer, McConnell, Hakeem Jeffries, Speaker Johnson will all be there. They have to talk about two things. One, that Ukraine aid that continues to be stalled. And then, of course, there's a potential government shutdown Friday night at midnight. Partial shutdown. Remember, the agencies are split up. So some things like Veteran Affairs, that would be shut down. But the big one would be March 8th. That's when, like, the Pentagon gets shut down. The issue I have is less so much the political polarization, but what this could mean. Moody's, at the moment, the only major agency that still has a AAA credit rating. But remember what they said in the fall. We're putting you on a watch list because there's political polarization. Does that watch list come into focus this week?
That's the drama in Washington. No drama this morning on Wall Street. Equities going absolutely nowhere on the S&P 500. Negative by not even 0.1%. In the bond market, yields not doing much. Your 10-year, 424.61. Coming up this hour, Michael Schall of Market Field Asset Management on the stock market's NVIDIA sensitivity. Ed Mills of Raymond James looking ahead to tomorrow's Michigan primary. And Subhadra Rajappa of SocGen as the Treasury market braces for a barrage of economic data and Treasury supply later this week. We begin with our top story this hour. Stocks inching back from NVIDIA-powered all-time highs. Michael Schall of Market Field Asset Management writing this. The index has become very sensitive to the performance of NVIDIA, the poster child of the AI revolution. And this strikes us as a late-cycle phenomenon in which all the attention becomes focused on a sliver of the market. Michael, I'm pleased to say, is with us around a table. So, Michael, some people think this is just getting started. You think it's about to end?
I think the technology is just getting started. But again, you know, it's very much a sort of late 90s type market where we're very excited about the future. And there are a limited number of companies that really represent that future. You know, I'm not the only person to have looked at NVIDIA and be reminded of Cisco in the late 1990s. And, you know, that was the beginning of the internet revolution. People did not overestimate how important the internet was going to be. And I suspect that's the case with AI. But markets tend to step ahead of long-term technological change.
I think a lot of people would turn around and say there is a big, big difference. The customers are minting money as well. So you've got 5 customers who are the biggest companies on the planet, who make up about 40% of the revenue for NVIDIA. They're real customers who make real money, paying for products from NVIDIA, and NVIDIA is minting money as well. This profit growth has been extraordinary. Isn't that the key differentiating factor between now and back then?
Yes, I think it is. I think it is somewhat different, and yet human behavior doesn't really change that much over 30 years or so. And I don't think we're better at staying calm and rational in the face of just incredibly exciting change than we were 30 years ago. It's not 1999. You don't have this, you know, slew of dot-com companies where you can literally count the number of days of cash that they have. You know, this is a very, very serious and you know, remarkably powerful change that we have ahead of us, but markets have never really been great at keeping their feet on the ground at times like these.
I do want to kind of get into the nitty-gritty because, honestly, I'm trying to read more about what NVIDIA actually does rather than just say NVIDIA and then everyone cheers. I mean, that's sort of where we're getting. And it seems like they're able to sell chips that have a lower barrier to entry at higher prices, the inferencing chips, versus, say, some of the training chips. I'm just wondering, what gives you pause? Are you outright selling NVIDIA, or are you just basically saying it can't take the rest of the market as far as some people expect?
Look, as I say, I just think that when we get very, very excited about a very small part of a market, it's a sign that at the very least, the secret is out there. It's heavily invested in, and you at least have to be cautious. I wouldn't think of short selling Nvidia. That strikes me as a very difficult thing to do. But I can't think of a company which is as dominant as Nvidia is today, keeping that dominance for a very long period of time.
So what's the playbook for late cycle where you think that there are sort of similarities to the late 1990s?
I think, the overall market is still okay. I think the economy is still okay. I think there are things I like about what's going on, particularly in global markets. I think we should be a little bit excited about Japan, which it's made its way to an all-time high. I thought Japan would make it to an all-time high, but I thought we'd be talking about it. I think, what's really remarkable to me is that Japan has got to an all-time high after, since 1989. I can't even do the math. What is it, 34 years? And we're not talking about it. So that excites me, that excites me a little bit. I think I give credit to people who understood what NVIDIA was going to be 18 months ago, because that, again, rather like Cisco in 1998, was the right place, was the right place to be. But by the point that we get to, I wrote this on Wednesday night, just before NVIDIA, in fact, NVIDIA had reported as I was writing it, so I knew it was going to be okay. But that level of everybody stopping and watching, and that's going to determine what the market's going to do, over the next 24, 48 hours, it's a little bit abnormal. I've seen it before. We'll see it again, but it's not what happens at the beginning of the story. So no, I don't think we're at the beginning of the AI revolution as far as the next 3 years of market returns are concerned.
The Nikkei 225 was looking at the index this morning. It's up 8% this month.
Yes.
This month. Just over the last 3-4 weeks, it's been absolutely phenomenal. When you look at what's happening on the ground in Japan, negative GDP, this is the disconnect for some people at least. GDP is negative in Japan, and we've got the equity market at an all-time high. In Germany, there's a struggle there. We've got the equity market at an all-time high. How relevant is growth around the world to what's happening in equities around the world?
I don't think GDP and corporate profitability are really the same thing. And corporations in Japan are really doing okay. And there really was a revolution under Abe that started a little bit more than a decade ago. And I remember being in Japan in 2013 and saying to people then, I felt this would be the beginning of a bull market which would take the Nikkei to an all-time high. I didn't think it would happen quickly. Probably I thought it would have happened before 10 years. But I think Japan has been through a corporate revolution. I think its corporate sector is much more fairly valued on average than our corporate sector. And I don't think GDP is completely irrelevant, but it's never been a very useful metric for making investments.
You see foreigners rushing back into Japan. Is part of that because a lot of them are also backing out of China, and you do see some companies moving plans to, say, Japan, like TSMC?
I think investors move much quicker than companies. I think, yes, absolutely. To the extent you have an Asian mandate, I think Japan has taken flows away from China, and quite rightly so. Maybe that particular trade has gone, too far. But I think the Japanese corporate sector has been underestimated and largely ignored. And yes, you are getting a rush of money in, but what I would have expected was a rush of money taking the Nikkei to a new all-time high. What we see is a reflexive, oh my God, it's at 39,000. I never thought that was possible. It's up, God knows what, year to date. It's like 18% or something year to date. Now you're seeing some money come in, and yes, maybe that money takes it too far and we have to go through some sort of consolidation. But it's remarkable that, what's still one of the world's key, global indexes and still one of the world's key economies can make its way to a generational high with so little excitement and so little conversation.
So just to sort of zoom out and put these two things together, are you basically saying that we're not necessarily going to see a massive bust like the 2020s the 2000 bust, but we might see the U.S. underperform some of these other areas as tech takes less of sort of front and center kind of role?
Yeah, I think that's a reasonable thing to say. I don't see the U.S. market falling apart right now. I think you have, we're forming a very, very overvalued, very, very narrow, and in the end, dangerous market. But I don't think it's going to fall apart first half of this year.
Nikkei up 17% year to date. Isn't that amazing? 17% higher year to date.
Especially given the fact that you've had the currency really underperform and people are really wondering what's going to happen with the Bank of Japan policy, and they're not necessarily going on a currency hedge basis, but there has been incredible enthusiasm around Japan, and we've talked about it a little bit. I just want to point that out.
A little bit, yes.
On this program we have.
Yes, yes.
Okay,
you
Michael,
guys are
thank
good.
you. Thank you, buddy. Michael Shea, you can stay. Dollar yen right now, 150.61. Let's give an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. KKR is said to be nearing a deal to buy a software business from Broadcom. It's worth about $4 billion. Sources say the deal could be announced as soon as today. Broadcom is selling its end-user computer unit, which it inherited through its VMware acquisition. The software also enables users to access desktop and applications remotely. Kathy Wood has sold shares in TSMC for the first time in more than 2 years. Her ARC Autonomous Technology and Robotics ETF sold 8,600 shares on Friday. It also sold more than 2,000 shares of TSMC's key customer, NVIDIA. Wood is trimming her holdings in the global chip bellwethers as artificial intelligence frenzy intensifies. Ryanair has warned it could be forced to pare back its schedule during the peak summer travel due to delays in Boeing jet deliveries. Ryanair may receive fewer than 40 Boeing 737 MAX jets before the end of June. The airline originally wanted 57 jets between the summer of 23 and 24. CEO Michael O'Leary warns aircraft shortages are likely to drive up European fares this summer. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, Nikki Haley refusing to give up.
There are huge numbers of voters in our Republican primaries who are saying they want an alternative. I'm not giving up this fight when a majority of Americans disapprove of both Donald Trump and Joe Biden.
That conversation up next, live from New York. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Live from New York City, equities pulling back by 0.1% on the S&P 500, inching lower from all-time highs at the close on Friday. In the bond market, yields not doing much. Your 10-year 4.24. Up next on the program, Nikki Haley refusing to give up.
There are huge numbers of voters in our Republican primaries who are saying they want an alternative. I'm not giving up this fight when a majority of Americans disapprove of both Donald Trump and Joe Biden. We're headed to Michigan tomorrow. And we're headed to the Super Tuesday states throughout all of next week.
It's the latest. Undeterred by a 20-point loss to Donald Trump in her home state of South Carolina, Nikki Haley already in Michigan, trying to drum up support ahead of the state's primaries tomorrow. Ed Mills of Raymond James writing, quote, "We have seen Trump pouncing Haley in primary votes, but Haley has a commanding lead over Biden in hypothetical matchups." Looking for polling in a three-way race between Biden, Trump and Haley. This is particularly interesting given the exit polling in South Carolina that shows 21% of Republicans, or 20% rather, of Republican voters say they will not support Trump in the general. Ed Mill joins us now for more. Ed, we've been talking about the end game here for Nikki Haley. What do you think the end game actually is?
Well, John, it does sound increasingly like she could be trying out a third-party candidacy. The No Labels Party has ballot access in 50 states, and they're looking for a candidate. Her statements there sound like that she's both running against Donald Trump and Joe Biden. We haven't seen a lot of polling details out in terms of how she would fare in a three-way race, but I do think there'll be a little bit of a boomlet here looking at that polling data, and if it looks good, there's going to be a lot of pressure for her to possibly try that third-party candidacy out.
Americans for Prosperity Action, though, are saying that they're going to be taking stock of their support of her. They're not going to donate to her any more financially. They will support her, of course, but they're going to look more down ballot to try to shore up some Republican senators and congressmen and women. So if she was to take on a third-party approach, who's funding that?
There's lots of donors that have given to some of these third-party organizations, such as No Labels. The super PAC that you mentioned is primarily funded by the Koch brothers. And, you know, when you look at the fact that Nikki Haley got 40% of the vote in South Carolina, her home state, but only picked up 3 delegates to Donald Trump's 47 delegates, that taking a stock and making a potential pause here is just a recognition of reality. Because as we go forward, we do have Super Tuesday where ballots are cast on a proportional basis for who gets the delegates. But after that, almost all states basically go to winner take all. So as long as Donald Trump is able to get a majority of these votes, he's going to get 100% of the delegates. So there's no path in that scenario unless Nikki Haley is actually able to get above 50%. And if you can't get it in your home state, that's very hard to get it outside of your home state.
True, but Trump is bringing 60% within South Carolina. That's closer to 50 than 100%. He's basically an incumbent, and I was struck by what G. Elliott Morris had to say at 538 over the weekend. Quote, "If Biden was winning only 60%, people would be freaking out." What kind of trouble does this spell for the former president ahead of November?
Anne-Marie, you know, the 60% in South Carolina is actually the high watermark so far for former President Trump. He was at 51% in Iowa, 54% in New Hampshire. And when we look at previous presidential elections, when you do have an incumbent, Donald Trump is not an incumbent, but the closest thing we've had since 1875, where a former president has run for re-election after losing the previous election. If you're not getting kind of those high 80, 90%, that shows a lack of enthusiasm among the base. Joe Biden, for example, got 96% of the vote in South Carolina in a primary a couple of weeks ago. So comparisons is some alarm bells for kind of who's going to show up in November. And I do think it's a reflection of, you know, we see a lot of polling data that the majority of Americans don't want this matchup, but this matchup is going to be close and probably won by the group that does not like either candidate, but can win over that group that does not like either of them.
How excited are you to talk about this for the next 9 months?
You know, I like to talk about policy. I think we have a government shutdown coming at the end of this week. Huge policy implications on a defense bill, a tax bill looming out there. So it's part of the job, but you know, the DC kind of one takes over the other at various points during the year.
If you like policy, and I'm with you, and frankly, I don't know that I hide it that well, but it's just not that thrilling for me to talk about this matchup that no one wants to see. But why are we not talking about why we have the situation to start with? Isn't this a complete indictment on the primary system that we have?
I think that will be litigated. What we've seen in the past is that when we have gone through the primary cycle and we've produced outcomes that the voters or the party don't like, that's when the system gets changed. So after a disastrous convention in 1968 for Democrats, That's why they have superdelegates. I remind folks that there's still those superdelegates out there today. So if something needs to happen come the Chicago convention here in 2024, does the history repeat itself where those superdelegates can make a change if they want to? Republicans can still make a change if they want to going into the convention. It's just unlikely at this point.
When you say if something needs to happen, what do you mean, Ed?
We have the two oldest candidates in the history of the United States running for president. One of the candidates has multiple felony charges against him. There is a lot of uncertainty in terms of what is the final result of this race, especially since it is so close. And so I'm in this camp where we think we know what's happening, but are there some unknown out there that's going to fundamentally change this race? I wouldn't be shocked. Obviously, I'd be surprised. But this is not a race that seems fully settled in most of the people that I talk to. When I go around talking to clients at Raymond James, our financial advisors, there's a sense out there something could happen that upends this race. So that's what I'm talking about, John.
Ed, thank you, sir. Appreciate it. Ed Mills of Raymond James. I'm not sure if that's a sense or a hope that maybe things change.
I keep going back to Libby Cantrell being like, Jamie Dimon's not going to be running.
Like, this is it.
Oprah Winfrey's not going to be running. It's going to be Trump versus Biden. Stop it with all the speculation. And yet.
Michael Schau, and yet. Final word, please. So rates haven't appeared to matter to this market so far year to date. GDP doesn't seem to matter to places like Japan. Does politics matter here stateside?
No. I mean, certainly not in February, March. Look, I mean, I think everybody's sort of scratching their heads and wondering how we got here, that we could have this race twice. I don't think, I don't think the fact that Trump will run against Biden in November is going to derail the market.
You don't think that it will derail the market if Trump becomes president? Do you start preparing for some of the policy shifts he's announced, like a more than 60% blanket tariff on Chinese imports?
Not yet. I think that there's questions as to what sort of a government he's actually going to lead if he gets in. By the way, I didn't say I thought Trump would win. I said I thought it would be Trump against Biden in November. I'm not sure who actually wins, because I think what we see is that nobody's base is very excited. You're going to be voting against somebody in this election, not voting for them, which is a little bit different. But no, I think it's too early to shift around a portfolio expecting different policies. I think we have some idea of what a Trump administration would look like, but I think it would be even more the maverick administration this time around compared to last time around, because the same people that he dragged into his administration last time around didn't do so well.
Michael Schau of Market Field Asset Management. Michael, thank you. The personnel choice here, Lisa, I think it's going to be pretty interesting. If it is Trump Volume 2, who's going to come on board? Especially because there are very different camps within his camp as far as people who actually have experience in the business world and who are not ideologues and those that are. We shall see. The Rex Tillersons, the Gary Cohns of this world, correct. Are they going to go back for more? I think it's doubtful this time around.
They'll flirt with it.
Coming up on this program, Chinese stocks pulling back after a strong rally kicking off the new year. Damien Sasser of Bloomberg Intelligence joins us next. Live from New York City with equity futures slightly negative on the S&P 500. This is Bloomberg.
regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Stocks just inching lower on the S&P. You want to talk about this? No, I didn't think so. And the Nasdaq were just about unchanged. They definitely don't want to talk about what they were talking about in the commercial break, live on TV. Focus on the bond market, 2-year, 10-year, 30-year. On a 2-year right now, yields just about unchanged, 468.37 on a 10-year, down a single basis point, 423.63. We'll keep going through some of the economic data for you this week. We'll talk about some of the supply coming from the Treasury as well. If you're just joining us, I'll go through the numbers again. It's worth it. They're huge. $63 billion of 2-year notes today, 5-year notes as well, $64 billion worth of 5-year notes coming to market. We get a 7-year as well, Lisa, tomorrow.
$42 billion there. This is a lot of money. I mean, we're talking $150 billion of sales, more than that, of just U.S. Treasury issuance at a time where either candidate who wins the rematch that we had in 2020 is going to basically increase the deficit. So this raises a question: when do higher yields become a tailwind, or rather a headwind, to markets that seem really immune to anything that doesn't rhyme with NVIDIA?
And the fact that they haven't so far, does that raise the ceiling for potentially higher yields from here? Because typically a sell-off in Treasury markets is self-limiting. It causes pain somewhere else, and then you get the bid coming back in. Hasn't happened so far, has it?
The only thing that will really curtail this kind of idea that maybe this is a market that can survive with 5.5% benchmark rates and that this is actually okay and not that tight, the only thing that could shift that narrative is true weakness, and we're not seeing that. If you're not seeing the weakness, maybe people start to realize, well, risk assets can keep rallying because this isn't that tight in any case. So that's the real threshold for me. When do we start to say, no, these conditions are restrictive, we just haven't seen the pain yet? And that, I think, will be the tipping point.
Subhadra Rajapra of SocGen joining us in about 15 minutes' time on why she still thinks this Treasury market might be a buy-the-dip market. We'll discuss that in just a moment. Let's finish on this. Bit of dollar weakness over the last few days, including against the euro this morning. The euro is positive against the dollar by about 1/3 of 1%, 108.53. Under surveillance, your top stories, a busy week of US economic data on deck. New home sales kicking things off today, but the key data point, core PCE deflator data, will be released on Thursday. The Bloomberg survey calling for a jump on the heels of a hotter than expected January inflation print. Get claims as well, and I think we should probably sit on claims again, Lisa. Claims were just exceptionally low on Thursday, and we were discussing NVIDIA for obvious reasons, but still exceptionally low.
People are ignoring the fact that the labor market is not cracking, that inflation isn't fading as quickly as people had previously expected, and we see an otherwise resilient economy that some would even say is reaccelerating in certain parts. How do you square that with the idea of immaculate disinflation, which was the linchpin of the rally that we saw at the end of last year? Something isn't squaring, but people are moving on.
We had a brilliant conversation with Jens Nordvig of Exante. He was talking about whether the Fed should set policy for NVIDIA earnings. Sort of tongue-in-cheek, but I think bigger picture, ultimately, there's a lot of spending happening right now, some big calls about a productivity boost, maybe sort of extending this cycle a whole lot further.
There is the hopes and dreams of a new labor market on the heels of artificial intelligence. NVIDIA embodies everything. It is sort of the holy grail of the labor market, is the holy grail of the equity market, it is the holy grail of a portfolio manager. For how long, right? We had Michael Schowell saying, this reminds me of the late 1990s.
Yeah.
anyone who tries to move away from that, Kathy Wood, is going to get, kind of slammed with underperformance. It is a difficult moment.
DC is just a constant stream of reality checks at the moment. Here's the latest from Senate Majority Leader Chuck Schumer warning of a looming government shutdown as efforts to agree to a spending package fell short this weekend. Some government agencies are only funded through the start of March, with the remainder facing a March 8 deadline. Schumer, Minority Leader Mitch McConnell, and Speaker Mike Johnson among the policymakers set to meet with President Biden tomorrow in a bid to avoid the shutdown. So, AMH, can we avoid that government shutdown?
Well, no, let's see. We have to read the tea leaves after this meeting. The president, by the way, will be in New York today, so be careful if you're taking cabs and you want to get to somewhere on time. Listen, what comes out of that meeting will be twofold. One, we'll get an update on potentially if we will hit a government shutdown, a partial one, because it's only some agencies that would lose funding March 1st, the remainder come March 8th, and then, of course, what happens to that foreign aid that's stalled. Speaker Schumer made a huge push for that over the weekend, actually traveling with a congressional delegation to Ukraine, but so far, Speaker Johnson doesn't want to take up that vote on the floor.
I've got one question. What time does he arrive in New York?
Sometime this morning, downtown.
That's all I want to know. Remember when the former president would come to town? Gridlock.
Got to take the subway.
Honestly.
Exactly. Thank you.
Just meet in Queens.
Yeah.
Well, he's going to land in Queens, but then, he's going to take the helicopter downtown, and then they'll be...
Just stay in Queens. I always thought they should just
PSA.
sort of stay in Queens. Move the UN to Queens. Move it all to Queens.
Or people like Jonathan Farrow could take the subway.
Part of a regeneration effort over in Queens.
When was the last time you were in Queens?
I was in Queens on the way to the airport last week.
There are a lot of wonderful things.
So similar to the president.
For AT&T customers. Really important story I should probably shift to. Affected by last week's network outage, with the company saying they'll issue a $5 credit on their wireless accounts. Hundreds of thousands of customers were left without service on Thursday due to the outage, which the company said was caused by a, quote, incorrect process occurring while it was expanding its wireless network. Hardly anybody is taking that on face value. Everyone's asking follow-up questions. What was that?
Well, I mean, yeah, because incorrect processing incorrect processing procedure doesn't mean anything. This does not resonate or compute with why you should have an outage from 9 a.m. to 3 p.m. And oh, by the way, if they're going to offer $5 per person, if they're going to be paying millions of dollars to their subscribers, shouldn't they invest that in making their processing changes maybe a little bit more efficient? I'm just throwing that out
True,
there.
but people are furious. So what they don't want them to do is go over and join Verizon. But to John's point, people might call and actually say, I actually need more than $5. I couldn't even call 911 that morning. But to the point about this processing error, it continuously reminds me of when an engineer comes over to fix your computer and says, did you turn it off and turn it on? The U.S. government is looking at whether or not this was a cyber attack, and that is the cloud that remains over AT&T, in my opinion.
I think that's the query we all have. What was it really? What was it really? And they keep repeating the same thing. Let's turn to China. Stocks in China pulling back after a strong rally following the Lunar New Year. The CSI 300 closing down 1%, snapping a 9-day winning streak, its best run since 2018. The index now positive on the year as a string of support measures in China, including state buying and short-selling restrictions, take effect. Damien Sassad, Chief Emerging Markets Credit Strategist at Bloomberg Intelligence, joined us around the table. Jay Pulowski, TPW, he said, when everyone starts to say it's uninvestable, maybe you should take a look at it. Is that what this is, a trade and not an investment off the back of some real fundamental shift?
I mean, it's definitely a trade. I mean, but it depends which part of the China market you want to invest in, right? I mean, I can make an argument that China government bonds are still a great buy. I mean, they have been, they probably are the only fixed income sector globally, or one of them that's actually positive year to date. So look, if you believe that the dovish bias at the PBOC is going to continue, which I believe it will, maybe buy China government bonds. I'm not advocating that, but you're talking about equities, and equities most certainly are a trade. And it's trade. I mean, look, if you just look at volumes, if you look at momentum, yeah, maybe sure you want to time the bottom and you want to try and buy the dip here, but you know, from an investment perspective, again, I stand by the fact that it really is investable. Fundamentally, it's just going to be very difficult to get behind Chinese equities in this current environment.
You mentioned Chinese government bonds. Let's talk about them just for a moment. Can you walk us through the difference between what's happened with Chinese government bonds this year and what's happened with treasuries? The data in America has been decent. Yields in America have repriced higher. If you're hoping that China's going to pick up sometime soon, is that the message that bond market in China is telling you at the moment?
You know, Jonathan, it's a great question. It's about the currencies. I mean, we're talking about, you know, why risk assets, why things haven't reacted the way. It's because the dollar bulls haven't really gotten their bullish move yet. And so what you're seeing here with the PBOC with China and with the fact that officials are basically able to kind of manage that currency and not let it break that far below 720, call it 725, you basically see sort of a a floor under the currency which allows CGBs to issue, to deliver a positive return in dollar terms. So I think that's one of the real forces here that's kind of holding back risk assets, the fact that the dollar is just not living up to the bullish dreams that a lot of people thought it would here, with rates kind of backing up here in the U.S. So I think that's something that you have to watch very closely.
What does it say about sentiment if people say, if everyone else is saying it's uninvestable, let's go? I mean, does that tell you that it's sort of reached a certain threshold of risk-taking?
I mean, look, I mean, people would also have you look at the data. They'd have you look at PMIs, which are trending higher globally right now, and certainly in emerging markets. And if you look at EMFX, that should track well with where PMIs are going, but it just hasn't done that yet this year. If you look at EM local, we're down 2.5% year to date. I mean, even the EM carry currencies, those in LATAM and EMEA, haven't really held up as well as one would expect. And you see now, finally, central banks across the EM landscape starting to cut. We're going to see Hungary cut by at least another 75 bips tomorrow, probably 100 bips. And so that's just a precursor of what's happening here. This higher interest rate regime we're in, now rates are compressing, now carries compressing, is now the time to kind of back out of your sort of, bullish non-dollar trades or investments. Sorry, Jonathan. I don't know if that's the answer yet, but I think, for the most part, yeah, I think it's probably wise to play for a little bit of dollar strength here because, look, of all the factors that are driving currencies, relative yield differentials have by far done the heavy lifting of all our models, and I think that's going to continue here for the next 3 to 6 months.
You really don't want to talk about China, do you?
No.
Okay, well, but it's because you're just trying to diverge to all of the rate cuts.
Let's talk about the Taylor Swift effect on Singapore.
I don't want to talk about the
Jonathan
Taylor
loves to
Swift
talk about
effect on Singapore. I still want to talk about China. I'm sorry, but it is the world's second biggest economy, and a lot of people are trying to figure out, okay, yes, rate differentials, risk-taking, et cetera. Why is it that the Bloomberg Commodity Index has reached its lowest level going back to 2021? Why is it that everyone's been hoping and dreaming for some sort of stimulus package from China that hasn't materialized, even though they've talked about it and flirted with it and given some rhetoric to that effect? Why are we not seeing the resurgence that you're seeing on the margins in some of the data?
Because I think all the money that's being raised in China is used to pay off their leverage and their debt. It's not being used to invest in new projects the way we had hoped, right? And so you're not seeing that demand for exports from Brazil, from Chile, from South Africa, from commodity producers writ large as you would have expected to see at this point in the cycle. We're hoping that will change. I mean, we're looking very closely at Taiwan and Korea trade data, right? Because look, let's be clear, we have Korea data out on Friday, I believe. You expect imports to decelerate, exports should accelerate. That should be good for the current account balance. It should be a sign of a bullish momentum into tech stocks globally. And then Taiwan also. Taiwan has done, I mean, their trade data is expected to pick up in January as well. Obviously with the Lunar New Year holiday, there should be a little bit of noise there. But I think, things writ large are improving at the margin. And I think, if you look at Asia, it's probably one of those kind of counter-cyclical plays because as the global growth picture improves, Asia with its low-yielding economies probably won't do as well.
The U.S. Chamber of Commerce head is in China this week. Do you think the worst is behind the way U.S. businesses think of trade relations with China, at least until the November election?
Well, I think you make a great point. I think one of the reasons the dollar is actually trading rich in most people's models is because of the tariff premium, which is now being baked into it because of a potential Trump reelection, right? I think that is something that a lot of eyes are on. I mean, look, again, the verdict is still out, and I mean, you guys debate this far better than...
Not much has changed with Trump tariffs on China. It hasn't changed.
Well, I mean, and it's also, I just think it's the market's perception of it. And I think that's really what is changing. The markets are coming to grips with the fact that, yeah, these tariffs are going to get a little bit more rigid on China. Things are actually going to get a little bit tighter globally from a trade perspective. And the outlet now, Korea, Taiwan specifically, Vietnam is another, Mexico is another. We're going to see, current account balance, we're going to see trade data in Mexico this week. It's all pointing to the fact that you're seeing this sort of swapping out of China into these other markets, and these other markets have not yet felt the benefit in terms of their asset prices rallying, but their economies aren't improving, Anne-Marie, and I think that's what we're looking at here.
The Mexico shift is absolutely amazing. Damien, good to see you. Great to catch up. Damien Sasser there of Bloomberg Intelligence. Equities right now on the S&P 500, down about 0.1% on the S&P. Anything but China. Just remember that next time we book Damien.
I get
Anything but China.
No, but then he's really smart on China. That's the amazing thing. He had that brilliance that came out afterwards that gave me a sense of why we're not seeing that dominance in the economy, because it's all going to pay back debt. I think
so you
that's
can come
great.
back to talk about China.
100%. Kicking and screaming.
You're allowed back. Damien, thank you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Britain's top antitrust enforcer has opened an investigation into 8 home builders over concerns of potential information sharing. The Competition and Markets Authority has opened a cartel investigation into the companies, alleging they may have exchanged competitively sensitive information. Regulators say that the info could be impacting site build-outs and new home prices. An initial information gathering stage will take place until December. Disney and Reliance Industries are said to have signed a binding pact to merge their operations in India. Sources tell Bloomberg that Reliance and its affiliates are expected to own at least 61% in the new entity, with Disney holding the rest. The new business is set to make a formidable media giant in one of the world's fastest growing markets. Disney has struggled to retain subscribers in India, where Reliance has cornered a large part of the local entertainment business in recent years. Cathie Wood has sold shares in TSMC for the first time in more than 2 years. Her ARC Autonomous Technology and Robotics ETF sold almost 8,600 shares in Taiwan's largest company on Friday. It also sold more than 2,000 shares of TSMC's key customer, NVIDIA. Wood is holding her trimmings in the global chip bellwethers as artificial intelligence frenzies intensify. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, bond traders bracing for a busy week ahead.
We're going to be buyers. 450 to 475. We still believe that. We still believe we'll have lower yields by the end of the year. And we think because of the sell-off, this makes a great buying opportunity.
Buying the dip in the bond market, that conversation just around the corner.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Live from New York City, equities pulling back by about 0.1% on the S&P 500, just a little bit softer after all the excitement of last week and the all-time highs that we saw close after close after close, even on Friday. Squeezed out, just a small day of gains. Yields a little bit lower this morning, down a basis point, 423.43 on a 10-year. Under surveillance this morning, bond traders bracing for a busy week ahead.
We're going to be buyers. 450 to 475. We still believe that. We still believe we'll have lower yields by the end of the year. And we think because of the sell-off, this makes a great buying opportunity, from a valuation perspective compared to 2023. The thing I like to say is valuations are not a timing tool, which is why we're tactically short now heading into the auctions, and we'll come out long.
Here's the latest this morning. Yields retreating from year-to-date highs ahead of 2- and 5-year auctions later today. This as traders prepare for more economic data throughout the week, including PCE data on Thursday. Subhadra Rajappa of SocGen writing, quote, as the immaculate disinflation narrative hits a speed bump, the Fed's data-dependent approach likely implies a gradual policy easing path and a higher terminal rate. The longer the Fed keeps policy elevated, the greater the impact will be on the broader economy. We continue to believe that risk to yields are biased to the downside. Subhadra Rajappa with us around the table. Subhadra, great to see you. Why is this still a buy-the-dip bond market for you?
Because we're at the end of the cycle and the market is not going to challenge the Fed like they did last year. August, September of last year, we saw the sell-off. 10-year yields rose dramatically in a very short amount of time. This is a very different time frame. The Fed is telling us that they're going to cut rates 3 times, and the market's not willing to challenge the Fed.
Equity markets aren't hurting, even though we've repriced rates higher. Stocks are at all-time highs. High-yield spreads are at the tights I don't think we've seen for a couple of years now in high-yield credit. Doesn't that just lift the potential for yields to go higher? Lisa and I were talking about this in the last hour or so, that usually bond sell-offs are self-limiting because they cause pain somewhere else, and then the buying comes back in. We haven't seen that so far. Does that lift the potential for yields to go up a little bit more?
Probably does, and that's why we've seen the yield, 10-year yields especially rise from around 4% to 4.25%. I think that that's part of that narrative. Financial conditions, as you pointed out, are extraordinarily easy. You know, the Fed has its own financial conditions index that they put out that looks at the interest rate sensitivity of the economy, mortgage rates, as well as a variety of other interest rate metrics that they look at. And it shows that financial conditions, even by that index, is quite easy. That said, I think that the market, at least the front end of the Treasury yield curve, the 2-year, is going to be priced to the path of the Fed. And I would say that the 2-year, the front end of the yield curve, is very efficiently priced in for a Fed path that's quite benign for the next couple of years.
So can you just give me a sense of why inflation would continue to go down if we do have pretty loose financial conditions and signs of ongoing strength in the ability to spend money?
Yeah, that's a very good question, and I think that that's exactly the speed bump that we hit in last week's data because of the fact that we saw that the consumer, broadly speaking, is still extraordinarily resilient despite higher interest rates. The spending has been extraordinarily robust. We don't really see a path from here on for a steady decline in inflation. If anything, I think you're going to see this back and forth. Although the broader trend from here on, I think, is towards very gradual decline over the next several years. I think 2.5% core PCE by the end of the year is attainable, but then getting from there to 2% is going to take a little longer.
This is the reason why I thought it was really fascinating. Stephen Major over at HSBC came out with one of his major letters overnight. He was talking about how the bond market is being pulled around by the tails. You have the fear of something happening, not the conviction that it will necessarily happen. Right tails include geopolitical risk, unsustainable fiscal policy, and runaway inflation. The left side brings us deflation and hard landing risks. It seems like deflation and hard landing risks aren't in the cards when we take a look at some of the data that's been coming in. So why doesn't that mean that yields are a whole lot higher if you're talking about the other side of this, which is the inflationary aspect?
So yes, there is on the one side you have the inflationary aspect, but the longer the Fed keeps rates higher, I think the higher the odds that we see a meaningful slowdown in growth, as well as decline in pressures and in growth pressures in general. So that's a point that I think Jefferson, the vice chair of the Fed, made last week, which is that the Fed always responds when growth starts to decline. So I think that that's always in the back of the mind of investors as well as the markets, is that even though inflation is a concern, with inflation having declined quite meaningfully over the last year, if there's a decline in growth, the Fed is going to respond. And the Fed is locked and loaded. So if there is a meaningful slowdown in growth, I think they're going to cut rates.
Lisa went through the numbers a few times already this morning. Let's do it again. $63 billion of 2-year notes. 5-year notes today, $64 billion. Tomorrow, 7-year notes, $42 billion. Does supply matter anymore?
It does, but there's a lot of cash on the sidelines, and investors are finding ways to put their money to work. You look at the equity markets, like you pointed out, it's at all-time highs. High yield spreads are tight. IG spreads are tight. So this is a very good diversification for investors that are already heavily invested in all these other asset classes. And you look at two-year yields in the context of year-to-date highs, it is a buying opportunity. So that's where I think that you're going to see this demand come into the bond market, regardless of what the fundamentals would say and the potential for perhaps even higher yields from here.
What I'm hearing from you is that the idea of the Fed put is basically making it a risk on no matter what happens in the actual economy. Risk on when it comes to buying bonds, risk on when it comes to buying riskier credit, risk on what we see in the stock market. Do you agree with that?
That's how it's been playing out so far. I think you're going to start seeing the weakness in the data appear from here on. We expected it in the first quarter. It doesn't look like it's materializing. But in the upcoming quarters, with interest rates staying as high as they are, you should start seeing some weakness in some of the data sectors. You're seeing delinquencies rise. You're seeing retail sales, for instance, starting to come under a little bit of pressure. So you are going to see the consumer come under pressure with interest rates remaining as high as they have been for as long as they have been.
Lindsay Piegza of Stifel tried to make the argument earlier this morning to us that consumer balance sheets are strong and there's space to lever up. Do you not agree with that?
There might be space to lever up. I think it's, to me, the way I view it is it's a haves and have-nots economy. There are some investors who can, and they have the bandwidth to do that. And then you have the cohort, perhaps those are the investors that are 40 and under that are paying student loans, have these credit card delinquencies, are seeing delinquencies in auto loans that are going to come under pressure. So you do have a bifurcation in the economy. Some sectors of the economy are doing well and others are not. And that's really where you're going to see the pressure.
Do you not buy that January then was just seasonal? Is it a blip? You actually think that there's pressure on this consumer?
There is, and I think that the longer interest rates stay high, you're going to see the pressure build up, especially in sectors like housing and auto loans. I mean, I think that you're seeing a decent amount of pressure already. You are seeing some easing of conditions there because interest rates have come down from 10-year yields around 5% to 4.25% now. But broadly speaking, consumers are not able to buy homes like they did several years ago. So the housing market is still under pressure. There's not enough supply, and housing prices are still relatively high. So there are certain sectors of the economy that are coming under pressure. It's just not broad-based in all sectors. And I think that that'll come over time with interest rates remaining high for longer.
It's just the problem with the US economy is people with 3% mortgages who won't sell their home,
They can't because they can't move.
You know what? I actually think that's a feature of our economic strength is that people were able to get 3% mortgages and they bought beautiful homes that they absolutely love and they've got no desire to move whatsoever.
Yeah.
And I just want to say that, they're what's upholding this economy.
So, Petra, this is personal, just so you know. This is highly personal. Highly personal. So, Petra, good to see you. So, Petra Schaffer of SocGen.
Thanks.
We'll talk more on the commercial break in a moment. Every time we talk about weakness happening in the labour market, I look at claims, 201 last week.
And what we heard from Lindsay Piegza was that you actually see real wages getting positive. So it's not just the stimulus payments, it's now that people are getting real money. And yeah, levering up, sure, but off 30-year lows in terms of their debt overhang, which is where maybe the potential comes from.
Another round of jobless claims about 3 days away, coming up on Thursday. In the next hour, Jim Bianco of Bianco Research, Mark Giannoni of Barclays, and Bloomberg's Mike Shepard and Mark Gurman, all joining us to talk politics and Apple. From New York City, this is Bloomberg.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, into dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They'd made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this. It has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
This is Bloomberg.
We've just come off a very strong earnings season for a lot of companies, and that's why we started the year very strong.
The tech sector are very, very strong. That looks like that's going to continue.
Everyone now who is caught short, everyone who is uninvested is pulling in.
Following this exuberance now still matters a lot, and it's still telling us, actually, that there is more positive momentum to go.
This earnings story is real. It's real. And if you don't buy it, you are going to be left behind.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance. Your equity market on the S&P 500, negative 0.1% on the S&P. The Fed is in no rush to start cutting interest rates, and this market isn't interested in that conversation anyway. Governor Waller, what's the rush? President Kashkari, we're not there yet. And Governor Bowman, Mickey Bowman, not now. Not now's the message from her.
Everyone's saying basically we're going to wait, and the bond market's kind of getting the message. Stock markets are saying we don't really care. What I'm really struck by in all of our conversations so far is the market right now seems to be caught between NVIDIA and the Fed put. If there is weakness, the Fed will come in and cut rates. If not, NVIDIA will lift all boats, and that seems to be the dynamic of this market.
How much space do they have to respond to a negative shock? Will they be constrained by inflation if it continues to creep higher? This market, I think, is willing to look past the January data just a little bit. You get a repeat in the February data, which is why February payrolls are going to be absolutely huge. And we get that data in 2 Fridays' time. So not this Friday, the following Friday, off the back of jobless claims, which I think we've said more than 5 times already this morning, were exceptionally low on Thursday.
That is the point of the morning, which is that essentially all of this works as long as inflation isn't that sticky. As long as inflation does keep coming down and the weakness that potentially comes down the pike is disinflationary. That's a big question mark, especially because what we have seen so far, the immaculate disinflation, has been on the heels of commodity disinflation, has been on the heels of year-over-year comparison figures that are much easier to beat than later this year. So that, to me, is kind of the rub.
Yeah, I think you're sort of raising the most important question of all of this. We're talking about how relevant monetary policy is to equity markets. How relevant has monetary policy been to the disinflation of the last 12 months? And if you go back to the last news conference with Chairman Powell, you got a sense that he wasn't that comfortable with what's developed over the last 6 months to sit there with confidence and say, we're ready to move.
It's been goods disinflation. And now you're starting to see it come back up. Refrigerators are getting more expensive. I just recently checked. But you are seeing some sort of sense that maybe we've hit some sort of peak or trough, rather, in the disinflation. And services spending keeps going up. So this is some of the debates that are underpinning a market that otherwise seems pretty sanguine right now.
We've got a lot to get through this hour. Let's start with your equity market on the S&P 500, 90 minutes away from the opening bell. Equity futures pulling back by 0.1%. Yields going nowhere at 424.22, and a euro a little stronger at 108.49. Coming up this hour, Jim Bianco of Bianco Research on what he's calling a disconnected market. Mark Giannone of Barclays looking ahead to this week's inflation data, and Bloomberg's Mark Gurman on Apple's plans to expand its wearables business. We'll catch up with legendary Apple reporter a little bit later in the hour. We begin with our top story. Stocks pulling back from a record ahead of this week's inflation data. Jim Bianco of Bianco Research saying there's a disconnect in a market at all-time highs, still looking for rate cuts. What is it going to take to get a rate cut? Simply bad economic data and weak inflation data. And what is the definition of bad data? Stocks react negatively. Instead, we have stocks flying on Nvidia saving the world and the opposite of bad data. Jim Bianco, I'm pleased to say, joins us now. Now, Jim, some people might say that maybe this market is just less sensitive to this bond market because Nvidia is producing real numbers, real results, and it makes up a bigger and larger chunk of this equity market. Are you looking for a reality check further down the road?
Yeah, I think ultimately a reality check will come. I mean, you could have two things be true at the same time. NVIDIA is producing, and it is concentrating the stock market, and it is bringing it higher. But at the other side of the equation, the economy is not breaking, and the economy is moving forward. And I would argue to you that the inflation rate is bottoming right now, somewhere, let's use year-over-year CPI, at around 3%, and that it won't really go much lower for the next several months. And then eventually the stock market's going to have to realize that the competition of higher rates is going to be a reality. Right now, it's being told by everybody, oh, don't worry whether or not there's going to be a cut in March. There's cuts coming. There's lower rates coming. The competition that you have to deal with, and I'm speaking specifically when you get away from the Mag 7, the competition that you're dealing with of higher interest rates will go away sometime this year. So it's all okay. But I think sometime this year, the reality is going to be that that's going to be very difficult to see those rates come down if the economy stays strong and inflation stays sticky.
Jim, almost exactly 12 months ago, the narrative shifted from soft landing to no landing at all. And then the following month, we had this stress in regional banks. Now, it feels like a repeat of that conversation, Jim. Data's really good. People start to talk about no landing. They move away from soft landing. At some point, yields go high enough that it starts to cause some pain, and then people start buying bonds again. Jim, where do you see those pockets of stress emerging? What are you sort of hyper-focused on right now?
Yeah, I think you're right that the old adage on Wall Street is, rates go up until something breaks. And I would actually argue that, at least on the rate side, we really haven't broken enough yet to do the damage that everybody thinks. So where does that come in? Let's go back to the October highs for a start, 5% in the 10-year note. We were able to weather that. We were able to weather, that holding 5.5 on the funds rate now since July without really breaking anything. What really got the rally going was the Fed chairman back in October, November, and the Treasury, by shifting its mix of bills and bond issuance, kicked off the rally. And that rally changed, at least in the last, I think, month or so, especially with Chairman Powell saying that he was in no hurry to cut rates and then going on 60 Minutes to emphasize that he was not ready to cut rates. So I think that rates have a ways to go up before they start to get to that it's hurting spot. And I don't even think it's really hurting housing. The thing I'm focused on with housing is, when do higher rates start to bring prices down? Yeah, they've brought sales down. And yeah, I've heard a lot of mortgage brokers and real estate agents complaining about low sales numbers. but home prices aren't coming down, which means the economy or people that own homes are not stressed. They're not being forced to sell.
So, Jim, what are you saying? That the Fed has to hike rates in order to break something, or that keeping rates at 5.5% is enough to kind of cause some discomfort in the underlying economy?
Lost the connection with Jim Bianco there. Jim Bianco of Bianco Research didn't fall asleep as Lisa was asking that question. The crazy froze.
I thought I was like, it wasn't that bad of a question.
We'll try and re-establish that
know.
connection a little bit later. I think you asked the right question.
Oh, thank you. I appreciate
Lindsay
it.
Pieter was flirting with the idea over at Stifel a little bit earlier this morning that maybe they need to go again. That are we truly sufficiently restrictive when you've got unemployment south of 4% for 24 months and jobless claims at 201?
When the Fed's own measure of financial conditions is incredibly loose, when they take into effect just how interest rate sensitive people with 3% mortgages that aren't going to leave, how much that really does create interest rate sensitivity in the economy. You know, this really is the question. Are we sufficiently restrictive if you see kind of expansion in certain sectors?
There's two ways of looking at this. There are always multiple ways of looking at the same thing. It's called a market. At the end of the day, he thinks this is a rational exuberance. At some point, the market has to start paying attention again to what is developing in the bond market, which is a 50 basis point repricing at the front end of the curve. Dave Pawlowski at TPW, way more constructive on the stock market because he believes we've seen a handoff from a Fed-driven market to one driven by earnings. And on the S&P 500, the bulk of it is tech, and tech is still delivering and printing money.
When do earnings fall off as a result of restrictive policy? And I actually am curious. I think we've got Jim reestablished.
I think he's back. He didn't fall asleep.
No,
he's back with us.
but that's what I was asking. Yeah. You're back. And I'm wondering, is that sort of what you're thinking, that we have to stay at 5%, say on the 10-year yield, for a prolonged period of time for things to break? Is it somewhat higher? Does the Fed have to hike rates again?
No, I don't think that we're right yet at the point that they have to hike rates. I was kind of in the 0 to 2 cut camp at the beginning of the year, and I'm more closer to the 0 camp, no cuts, for right now. I think that higher for longer is good enough. Are we going to flip over, like Larry Summers has been talking about, the possibility that we might have to see more rate hikes this year? I mean, I wouldn't rule it out, but I would say that the probability is less than 50% right now. But, you know, I think the real thing that we have to keep in mind is these rates, these level of rates aren't hurting much. They're really not, you know, they're not dragging the economy. They're not dragging earnings. And you could argue, if you look at inflation, that inflation is not really in a last mile mode on its way to 2%. I think it's really almost done, at least on a year over year basis, going down. And that is not what the Fed is looking for right now. They're looking for 2% inflation, and they're looking for signs that the economy is unmistakably weak before they react by cutting rates. And they're just not getting that right now.
Jim, I want to give it credit where it's due. You made this call coming into the new year. I want to be very clear with our audience about that. It's not like you're looking at the recent data and saying inflation is bottoming out, not topping. This is something we're looking for at the end of the year, coming into the start of this year. Jim, can you tell me then, if you think we're finding a floor for inflation, where do you think it's going to level out? And ultimately, do you think it can climb from here into year end?
I think it's leveling out right here. Let me use year-over-year CPI headline. It's somewhere around 3%. Maybe it hits 2.928. I understand we're at 3.1, and that doesn't give me a whole lot more room. The base effect, meaning that the numbers after February's number get very, very low. You drop 1/10 and 2/10 from a year ago, and all you need is a 1/10 or 2/10 to keep it at near 3%. Gasoline prices have moved up so that while the February number that we dropped from a year ago was large, we've got higher gasoline prices to push it up as well. And I've been one that has been arguing that on the shelter or the housing aspects of inflation, that those numbers are going to stay sticky. They're not going to come down as fast as everybody thinks. We saw that in January when owner's equivalent rent jumped to 0.6. You add all this up and you're looking at potentially being in the high 2s, probably in the low 3s, all the way through the end of the summer with inflation. And if that's really what's going to happen, I can't see the Fed declaring victory in that point and cutting rates. Now, they maybe won't hike them, but a market that was pricing in 7 rate cuts a little over a month ago might be looking at like none to 1 before the end of the year, and that will come as a big surprise to it as it starts to understand it.
We've priced out about 4 of them without a splash. That's what's amazing, Jim. You've run from one side of the boat to the other without a splash. High yield spreads have got tighter, not wider, and credit spreads are even tighter now than they were a week or so ago. Lisa, it's amazing.
It's this idea that either the strength continues that supports risk, or the Fed will step in. And I think the difference that Jim is talking about is maybe they're not going to step in nearly as quickly as people think.
Jim, great to catch up, buddy. Jim Bianco there of Bianco Research. Did you notice Jim's strategy to deal with a tough question from Bramo? Shut your eyes.
Shut your eyes and hope for the best.
Freeze.
Yeah, exactly.
Just pretend the line's gone down. Do you remember that guy? Do you remember that clip of that guy that was asked, what does that company do? And he just went silent and pretended there was a technical connection. It was a problem.
That's amazing. That was actually really popular during the pandemic. There were all these videos.
Just pretend the line went down.
Where they would pretend that they kind of froze so the teacher wouldn't call on them, and then there would be like a cat
that's
walking
what they're
in the
doing
background.
with school?
Yeah.
Oh, that's great.
For remote learning.
I love that.
Lots of creativity.
I love that. Jim, thank you, buddy. Equity futures on the S&P 500, totally unchanged here. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. A powerful Charles Koch-backed network announced it will no longer fund Nikki Haley's presidential campaign. It's a major reversal. Much of the Republican donor class had thrown its weight and money behind Haley as an alternative to Donald Trump. Haley was defeated in her home state of South Carolina over the weekend with a 20-point loss to Trump. Haley has vowed to stay into the race until Super Tuesday on March 5th. Goldman Sachs has won $1 billion of a private credit deal with Mubadala. They plan to invest in the Asia-Pacific region with a focus on India. The head of direct lending at Goldman's money management unit said, quote, we want to partner up with investors who have Asia exposure, and they want to go with a platform that has experience and track record. Ryanair has warned it could be forced to pare back its schedule during the peak summer travel season due to delays in Boeing jet deliveries. Ryanair may receive fewer than 40 Boeing 737 MAX jets before the end of June. The airline originally wanted 57 between summer of 2023 and 2024. CEO Michael O'Leary warns that aircraft shortages are likely to drive up European fares this summer. And that's your Bloomberg Brief, John.
Danny, thank you. Choice words from Michael O'Leary. I suggest you Google them to find out the actual language that was used. Up next on the program, yet another shutdown in sight.
I think we have a government shutdown coming at the end of this week. Huge policy implications on a defense bill, a tax bill looming out there. DC kind of one takes over the other at various points during the year.
That conversation up next.
Was going to keep rating World Cup. This is a 3 as the economic picture covering the intersections of Hollywood, Silicon Valley, and beyond.
From the UK, and I'm the inventor of the gel razor. And today I'm looking for an angel investor to fund my project, the gel razor, whether that's a working concept and working prototype, or manufacturing possibilities with investment, or to get me a licensing deal secured. If you go in any supermarket today, you will see packets of razors sold separately with tins of mousse or gel. Hence I did all in one. The idea is You pressurise the handle, the gel flows through the reservoir up to the head of the razor, coating the blades, ready for shave. My target market is 18 plus, male or female, male blue version, female pink version. What I'm looking for in an investor is someone who's passionate, determined, shares my vision. That's an important step for me, and willing to succeed as I wanted to succeed myself. Patented in the UK in 2021 September with copyright protection. I have a logo for the gel razor, which you will see on my LinkedIn profile. Currently working with a company in the US who have done me a lovely sell sheet. Big up to them guys. So if you're interested, contact me on LinkedIn profile, Paul J. Gwilt, GWILT, or email me at mufc219@gmail.com.
Making, but I will say that the risk does look higher with each passing day. We were expecting last night to see at least the contours of some sort of spending plan to come from Mike Johnson and his allies, but it didn't land. And the inability to deliver that in part was what prompted Chuck Schumer to express his concern. It was, late afternoon yesterday that Schumer was pointing out that things were slowing down on the House Republican side. What Johnson is facing actually is a lot of pressure from the hardliners in his caucus who really are still pushing for a border deal. They want tougher border measures along the southern U.S. frontier with Mexico, and they are now trying to look at these must-pass spending bills, which have to be completed by Friday, as a way to get what they want.
Shep, if any department is operating, though, under a stopgap funding measure by April 30th, it's a 1% cut across the board. How many within the Republican Party actually want to drag this out to then just to see that cut across the board starting after April 30th?
That's a great question, because when you think about it, it would be something they would maybe just want to run the clock out on and let snap into place. However, some of that funding trickles back to their districts, and they may see things in services and activities that end up getting cut back home. So it's one of those things that sounds good in principle, and yet when put into practice, it may actually deliver the kind of bite that they and their constituents are a little wary of. So we'll have to see. And our teams on Capitol Hill have been asking this question. So what is your end game here? For the moment, they are just fighting the battle that's immediately in front of them, and that is over the border and now trying to use this spending measure as a way to do it. But some of them may be thinking the long game, too, to exactly what you're pointing to, this automatic snap-in of 1% spending cuts across the board.
Does the contours of the negotiations change given the fact that the president has invited Schumer, McConnell, Jeffries, and Johnson to the White House?
Well, it adds a different element for sure. And Biden is also going to bring up the question of Ukraine aid. It is something that he asked for back in October, and here we are. It's almost March, and Congress has yet to complete work on that package, even as Ukrainian forces are struggling to keep up against the Russian invasion. Now, Biden also recognizes that, the shutdown is something that he needs to avoid as well. He doesn't want to have any of it splash back on him. That is in part why he is bringing the leaders from both parties in the House and the Senate in on Tuesday to talk about this and try to reach some sort of breakthrough or understanding. House Speaker Mike Johnson has indicated his willingness to cut a deal and compromise. But as I said, his negotiating and leeway, his negotiating room and leeway in terms of dealing with Biden and Democrats is limited by the demands of his right flank and also the threat that they may come after him and his job.
Well, that was going to be my next point. It seems like he's damned if he does and damned if he doesn't. He has to work with Democrats regardless at some point to keep the government open, right? But then at that point, he could potentially lose his job. How acrimonious has it been amongst him and his caucus? Because a lot of reporting that it hasn't been going so well for him at the top job.
It's been a rough go from the start. He took the job, in fact, in the aftermath of another spending battle that cost House Speaker Kevin McCarthy his. McCarthy had reached across the aisle and forged a compromise that prompted this so-called motion to vacate that allowed any one member of the House Republican caucus to call for a vote on whether the speaker should be ousted. McCarthy lost. It took days and days of negotiation and candidates to come up with Mike Johnson, and now he finds himself in that same pickle. And the tensions and the tempers have not eased. What we've seen on Capitol Hill, if anything, they're growing more and more frustrated with Johnson's inability to really bring together this very narrow majority. And remember, they just lost that House seat in New York in a special election a few weeks ago, and that's further limited his negotiating maneuvering room.
How difficult do these negotiations become as we get further along into the primary season?
Well, it's already here, and I think the election already is weighing on this. Former President Donald Trump has weighed on the talks over the border. We saw him calling on Republicans to scuttle the border Ukraine deal not too long ago, and we can look for him maybe to weigh in on whether they should try to do something to either force Democrats' hands by using the threat of a shutdown. So we'll be paying attention to how this plays out on the presidential campaign trail as well.
Shep, good to hear from you. Always is. Michael Shepard there of Bloomberg down in Washington, D.C. Amazing to me, Anne-Marie, we talk about this division down in Washington all the time between the Republican Party and the Democrats, within each individual party as well, within the Republican Party, within the Democratic Party too. And yet there is still a belief somewhere from policy analysts that join this program who believe that we can pass aid for Ukraine, that we can pass aid for the Middle East, and we can do that sometime soon.
Well, because many are saying that if you look at the numbers on a bipartisan basis, if you were put it on a clean vote up or down on the House floor, Ukraine aid would pass. The issue is getting it to the floor and what that means for Speaker Johnson as he deals with the right flank of his party.
I'm just wondering how Michael Johnson's going to do this, because there's this question of how he's not going to face the same fate as his predecessor, how he's going to wrangle a group of people who are making it their campaign pitches to say no to everything, at the same time while still seeming like he's part of that flank.
The pressure is just as high, yet the margins are even smaller this time for him.
Much smaller because of New York 3, as Mike Shep was just talking about, Tom Suozzi grabbing Santos' seat. Also, you have to think, April 30th, based on the deal Biden did with former Speaker McCarthy, there's a 1% cut across the board. How many fiscal conservatives are saying, run out the clock till April 30th, no deal, and then we get a cut across the board? But then you have the defense hawks in the Republican Party who say that is not going to be good for the defense budget.
Well, that's enough excitement. Pull up the S&P 500 futures.
This
Unchanged.
is where the excitement is.
Going absolutely nowhere.
C is more exciting today than Wall Street, I have to say.
Going absolutely nowhere. Coming up next on the program, Mark Giannone of Barclays on why he thinks the Fed will cut 3 times this year. We'll get into that in just a moment. Here's a state of things for you right now cross-asset. Equities going nowhere. Bonds are going nowhere. The 2 years just south of 470. We're going to go somewhere this week. We've got a lot of economic data, Lisa, a lot of Fed speak, and a ton of Treasury issuance as well.
Yeah, we're talking about 2-year and 5-year auctions today. $63 billion and $64 billion, and tomorrow $42 billion. Tons of stuff coming to market, and will it matter?
It's real money.
It is real money.
It's real money. Peter Chia of Academy thinks that deficit, that supply, those forces will reassert themselves as this year progresses. We'll see. Live from New York City this morning. Good morning. This is Bloomberg.
timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Neil Dutta, good morning. Consensus needs to wake up.
Love it.
Neil's language over at Renmac this morning. They're offside on growth again. Recent data points to CapEx picking up. Productivity to advance. He puts a question mark on there. January is a fluky inflation month. The earnings outlook should improve. More via the link. I'll click on that in a moment, Neil, but consensus needs to wake up is the ultimate message here from Neil Dutta.
Which means that the economy is doing great, maybe even better than people expect. Neil, come on soon, and please explain to us how everything's going to continue to be that way, given where rates will have to go if that really is the case.
Looking forward to catching up with Neil sometime soon. When everyone else wakes up, maybe. Equities on the S&P 500. That's such Neil Dutta language, isn't it? Just sort of, you know,
provocative.
Sort of upset everybody else. On the Nasdaq, positive by 0.1% on the Nasdaq 100. The S&P going nowhere. Small caps were lower last week. I think that's interesting. Everything else was higher. Small caps were lower. We're down at 0.4% this morning. Small caps were tough. Regional banks have been tough. We can talk about the equity market and the index level being less sensitive to what's happening in the bond market, Lisa, but there are some rate-sensitive parts of this market that do not like to see this 2-year at 469.
So rates still do matter. For those that are wondering, it actually still does relate to the economy and relates to certain earnings, which raises the question, is there a broader kind of downshift in broader equities in response to higher yields if the consensus needs to wakes up, and suddenly that strength gets baked into even higher yields from here?
The 10-year pretty sleepy so far, 425 on a 10-year this morning. I'll finish on foreign exchange. You like that? Yeah. The euro right now against the dollar, slightly stronger. Some dollar weakness over the last week. We add to that. At the moment, euro-dollar 108.53. That currency pair positive by 1/3%. Under surveillance this morning, your top stories. Warren Buffett's favorite Japanese trading houses are climbing after the Berkshire Hathaway chief's ringing endorsement in his annual investor letter. Buffett saying the companies follow shareholder-friendly policies that are, quote, superior to those practiced in the US. Some of those banks are among those rising to outperform the broader market today. The gains coming after the Nikkei 225 reached an all-time high last week, driven by the global tech rally and a weaker Japanese yen. The Japanese yen call is the interesting piece of this. So this month alone, the Nikkei 225 is up 8%. Year to date, it's up about 17 percentage points, which is amazing. But if you believe that we start to get interest rate hikes from the BOJ and dollar yen comes down from 150 to what I don't know, what does it mean for this trade?
It means it gets potentially, well, it depends what your funding currency is, right? But potentially, if they hike rates and the yen gets stronger, it could turbocharge it on one hand, or it could potentially undermine it if it means more weakness in the economy. Either way, people seem to be looking past that and saying that right now, these economies, whether they're levered to the global economy and the U.S. in particular, or whether it really is that the Japanese economy is finally breaking out, are seeing life for the first time since 1989.
Some of those banks are at rates higher, and they haven't had that for a long, long time.
And you would imagine that that would benefit them quite dramatically, which is the reason why he owns, what, 9% of some of them?
It's amazing, isn't it? Neil Dutta of Renmac, by the way, booked on the show Thursday, I'm told by our producers. Bit of a shuffle taking place on Wall Street. Let's get you some of the names and where they're going to. JP Morgan's announcing 2 co-heads to lead its global banking unit. The firm combining its commercial, corporate and investment banking businesses under Doug Petno and Filippo Gori to, quote, better align our coverage of clients as they grow in size and complexity. The pair replacing Viz Raghavan, who left the bank to join Citi. So a couple of movements there to help lead the Asia business and I believe the European business as well.
Of course, when I saw the redhead, I thought, is this going to somehow represent the new leadership ranks that could replace Jamie Dimon someday if he ever leaves the helm? This, to me, is interesting from one standpoint. Filippo Gori was coming from Asia Pacific, and he basically was talking about India being really important and the main driver. So how much does this sort of shift where the businesses go and such? Maybe this is just replacing, someone individual, but you always kind of wonder the intrigue of the changing of the guards at the world's biggest bank.
It's quite a move for Citi, though. That's quite a catch for Citi. That's not what you would consider to be, at least over the last 10 years, top-tier bank on Wall Street's been JP Morgan. For them to poach someone away from them is pretty impressive.
So I don't like to speculate, but to speculate, there is this question of how much is it the leadership ranks have been very difficult to penetrate at JP Morgan, where there's sort of a lock at the top, and even at the ranks below. At Citigroup, there's a complete shakeup going on. It's a new leadership. It's a new kind of feeling of a reorganization. So how much is that a lure for certain talent that wants to really put their stamp on something?
I think that's absolutely key. And if you could have a conversation with Jen Peepsack and Marianne Lake, maybe they'd tell you, but I imagine on the record they might not go there. A slew of economic data coming out this week, you could try, including the Fed's preferred inflation gauge, the PCE deflator on Thursday. Bloomberg Economics estimating core underlying inflation rising month over month, marking the second straight acceleration for a gauge that's mostly been receding the past 2 years. Other data out this week includes durable goods, fourth quarter GDP, weekly jobless claims, and consumer sentiment as well. Looking at all of that is Barclays chief US economist Mark Giannone saying this: the data released since the January FOMC meeting, in particular the solid increase in January CPI, likely reduces the FOMC's confidence that a sustained return to 2% inflation is in train. We think the FOMC will need to see several months of good data before starting to cut. We expect conditions will be in place for a first rate cut in June, but this is predicated on a gradual moderation in inflation. Mark, I'm pleased to say, joins us around the table. Mark, good morning to you.
Good morning, John.
Are we going to get that gradual moderation in inflation this week?
I don't think we're going to have it this week. This week we predict also an increase of 0.4% in the PCE inflation month on month. So that's going to be a substantial reacceleration compared to what we have seen in the recent month. But going forward, we expect the trend downward of inflation, broadly inflation measures to come down. So remember that PCE inflation has been particularly low over the past 6 months or so. Up until December, it averaged an annualized 1.9% for the core PCE measure. We think this is going to move up a little bit, so firm on the PCE, but the overall inflation trend is turning down.
Can you just frame that for us? How big is the spread right now between PCE, Fed's preferred gauge, and CPI, which gets all the headlines? How big is that spread at the moment?
So the spread is over 100 basis points. It was like in December, 130 basis points.
Connection lost.
For the 6 month annualized. And this is an unusually large spread. So we expect that to gradually come down as some of the PCE, the pressures that we see on the CPI actually are moderating. And on the PCE, we see some of the component actually firming a little bit in coming months. So we expect that spread to gradually come down.
So what gives you confidence that this disinflation isn't transitory? And if your head is spinning, that basically we're going to get some sort of stickiness to the Jim Bianco view of 3%, and that will be the bottom of inflation before it climbs back up?
So I don't think 3% is going to be the bottom of inflation just because the Fed won't accept that. And if it were to stay at 3%, I think we should be prepared for rates to stay where they are for a long time or even go up a little bit from where they are. So I don't think 3% is an option here. I think what we'll see is some gradual moderation in activity. In particular, in the drivers of activity have been consumption, really the strength in demand there, in particular in consumption. So with the rates remaining elevated for some time, we think that consumption demand is going to gradually slow down, and that's going to diminish some of the price pressures.
When do you start to rethink rate cuts at all this year?
Well, I think if and when we see these inflation stalling at around 3%. So if we see the PCE inflation going up like more after the January month, let's say in February and March, We see some further acceleration in there, and we see the CPI inflation not coming down from where it is. So it, as I said, it annualizes at around like 3.3, 3.4% over the past 6-7 months. If that remains as strong as that and doesn't diminish from here, I think the rate hikes are going to be on the table again.
Do you think that right now, where benchmark rates are, and frankly the Treasury market, that conditions truly are restrictive if we're not seeing that weakness?
So the Fed says that they think that they are very restrictive. I believe that they are restrictive, but not very restrictive. So if you think about the natural rate of interest or the equilibrium interest rates that would bring the economy back at full employment and maybe with inflation in line with its target, that natural rate of interest would be around, we would think 5%. So that means 2.5% maybe real rate in the short term and 2.5% in inflation expectation. So a Fed funds rate at 5.25, 5.5 is restrictive, but not particularly restrictive in that respect. Now we expect this natural rate to gradually come down in coming quarters as the economy slows, and we expect the inflation as well to move gradually down as well, so that longer term we would be closer to 3% probably than the current level. But we think that policy currently is somewhat restrictive, but not particularly so.
What's the real world evidence for that? Looking at outcomes, consequences, where do you see that? What's the greatest piece of evidence that they are restrictive?
Well, they are a bit restrictive, but I think consumption is very, very strong. And I think one feature or one source of strength here for consumption is this persistent feedback loop we've seen between a very tight labor market that keeps generating jobs every month, it keeps generating income every month, and that income basically fuels consumption. And consumers then turn around, buy all sorts of goods and services, and keeping sort of pressure on labor demand strong and pressure on prices still pretty elevated. So we think that feedback loop continues, will eventually slow, but that suggests to us that, yes, policy is somewhat restrictive, but the fact that this has not really crushed the demand suggests that that policy is not particularly restrictive.
Forgive me for playing with more words around restrictive, but sufficiently restrictive, are they?
Well, it depends on what time horizon you set up.
Okay.
If you are patient and you think that inflation can come down, within the next few years towards the 2%, so you can stay mildly restrictive, and you're eventually going to get there. If you want to get there sooner, or you worry that people are going to revise their inflation expectation up, then you probably may want to be a little more restrictive.
Interesting, Mark. Appreciate it. Mark Giannone of Barclays. I just about caught up and carried on catching up as the conversation continued. Trying to catch up with this as well. Piper Sandler, another upgrade on the S&P 500 year-end price target. They've got a new one. It was 5K. It's now 52.50 on the S&P 500 year-end over at Piper Sandler. This after upgrades that we got just last week from Goldman Sachs, who are now looking for 5,200. I think the second upgrade we've had from them in the last few months. And likewise on UBS, Jonathan Golub now looking for something like 5,400 over at UBS with Jonathan Golub and Patrick Palfrey. This is the line that we're getting from Piper Sandler this morning. At the start of the year, we put out a 5K year-end price target on the S&P, thinking we'd see the market range between +5 and -10%, with downside risk being a possible resurgence in higher bond yields. A lot of people found that way. We got those higher bond yields, the equity market just kept on rallying. As the earnings strength for larger cap growth continues, we are adjusting our year-end target higher to communicate a constructive view on this area of the market. Because they go on to say we do not have as bullish views on areas of the market that do not have rising earnings estimates, namely small caps. And small caps last week, Lisa, where there was a little bit of trouble.
There's a nuance here, where basically you can have a segment of the market that continues to fall off even as the rest continues to rally. But this really goes to what Max Kettner was talking about as well, which is why he shifted his view to be not underweight necessarily some of the risk assets. Rates repriced, he got that right. The response to it and the orderly nature of it has been what surprised him. And sentiment and positioning hasn't shifted. It might be stretched, but people keep piling in.
Neil Dutta just sent me a private message just to make sure we didn't miss it. The consensus is so offside on growth.
Yeah,
just to repeat the same thing
We got
again.
it. Neil, just
got
let
it,
you
Neil.
know.
Thank you, buddy. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Kathy Wood has sold shares in TSMC for the first time in more than 2 years. Her ARC Autonomous Technology and Robotics ETF sold almost 8,600 shares in Taiwan's largest company on Friday. It also sold more than 2,000 shares of TSMC's key customer, NVIDIA. Wood is trimming her holdings in the global chip bellwethers as the artificial intelligence frenzy intensifies. JP Morgan Chase CEO Jamie Dimon and his family have sold $150 million worth of the bank's stock. It's Dimon's first of his shares since taking the helm 18 years ago. Dimon and his family sold more than 800,000 shares on Thursday. They're trading at a record high. And Republican National Committee Chair Ronna McDaniel is leaving her post after weeks of pressure from Donald Trump. McDaniel has led the RNC since 2017, but has been under scrutiny after a slew of election losses and disappointing fundraiser results. Trump is now endorsing daughter-in-law Laura Trump to co-chair the party. During his victory speech in South Carolina on Saturday, Trump also suggested a possible role for former White House aide Kellyanne Conway. That's your Bloomberg Brief. John.
Danny, thank you. Up next on this program, Apple betting on wearables.
This is laying the groundwork for the next form factor. And if you look at Vision Pro 2 years from now, we think it's going to resemble sunglasses and be less than $1,500.
That's coming up next. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
NVIDIA check for those of you that want it. The stock is up by a little more than 1% in pre-market trade, and the cash open about 44 minutes away. Equity futures positive here by 0.1%. Yields lower by almost a basis point, 423.83. Under surveillance this morning, Apple betting on wearables.
This is laying the groundwork for the next form factor. And if you look at Vision Pro 2 years from now, we think it's going to resemble sunglasses and be less than $1,500. And it's all about tapping the install base. Developers are the key here. This is something I think the street's missing in terms of what this is ultimately going to lead to.
It's the latest. Apple looking to expand its lineup of wearable devices. The company exploring a fitness ring, smart glasses, and possible AirPods with cameras. This comes in the wake of mixed reviews for its 3500 Vision Pro headset. Competition in the wearable space heating up with competitor Samsung debuting its first health tracking ring at the Mobile World Congress underway in Barcelona. Bloomberg's Mark Gurman joins us now. Famed Apple reporter Mark Gurman, let's get straight to it. What are you hearing and how seriously should we take some of these considerations?
Yeah, thank you for having me. So what I'm hearing is Apple is looking at all sorts of new wearable devices to augment the AirPods and the Vision Pro and the Apple Watch. One thing they looked at a few years ago was a smart ring, similar to what Samsung introduced formally this week, but I don't actually believe the smart ring is currently still in development or something that Apple is planning at this point to bring to market. But more interestingly, are how they can blend AR and AI into new head-worn AR devices, right? And so one consideration is smart glasses, not AR glasses, but smart glasses with clear lenses, but that use special speakers and external cameras that use AI, right? And voice control. The cameras can see what you're looking at, and then you can use your voice to help understand your surroundings. You can use your voice sort of like you normally would with Siri, and they would be a sort of upgraded type of AirPods with better battery life and new sensors. The other thing they're looking at is simply adding that same technology into AirPods, so having AirPods with cameras in it, so they could identify your surroundings, and you can use all sorts of AI and AR features with that to really have a better understanding of the world around you. Now, ultimately, like I said, I don't think the Ring is going to come to market. I do believe the AirPods will get cameras and additional sensors, however, one day. And I do believe they're taking a very close look if they're going to release sort of non-AR display glasses as a stepping stone to those eventually coming out probably 5 years from now.
So, Mark, do they complement the iPhone or replace it?
Yeah, I think all these products are complementary products to the iPhone. I think there was a lot of discussion a few years ago about the idea of augmented reality glasses replacing the iPhone. My take on that has changed. I don't necessarily think the iPhone is going to go anywhere. Just like people thought that iPads and bigger smartphones would cannibalize laptops, right? Laptops have gone absolutely nowhere. But will they change in form factor? Will the phone eventually become the laptop? I think that everyone is going to still carry phones for decades to come. You still need that sort of main device. You need that product with that bigger display. But AR glasses will eventually arrive to augment that. I think the bigger shift is going to be from perhaps the watch or the ring that some people are doing to more of those head-worn portable products.
I'm just sitting here trying to imagine a world where people are even more distracted and separated from other people in the reality, and then instead kind of communicating with them in some sort of technological or metaverse, if you will, that's been left for dead. I mean, is that the reality that we're talking about? Some people were talking about the idea that some of these wearables would replace the need to be glued to a screen, but you're saying that's not it at all. This is just another way to reach the metaverse.
Yeah, you know, I don't think the metaverse is influenced here. I don't think this has much to do with the metaverse. I think that the ultimate vision are these augmented reality glasses. This won't be in the next 2 years. This won't be under $1,500. This is going to be 5 years from now and very expensive. The idea being that you're getting all that information you normally get on an Apple Watch into your field of view. And I think there's room for multiple products, right? I think there's room for the Vision Pro at home as sort of a entertainment and content consumption device, maybe as a computer replacement, right? I think that's a very viable situation. And then on the go, right, instead of normally using your Apple Watch as you're out and about, you have those augmented reality glasses. You can use them to do your music playback. You can use them to do your voice control, your text messages, your phone calls, all on the go, things you normally use for a phone as you're walking down the street or you're walking amongst the office, right? Whereas maybe you would use the phone when you're sitting down for a little bit more complex task. And if you want to get real work done, maybe you're using a Vision Pro or an iPad or a laptop or some such. But the big idea is that all of these products need to work together and integrate. And Apple is not going to let each product cannibalize each other. They're going to leave room for the products to work better together because they technically want consumers to own everything. They don't want you to choose between one product or another. They want you to have a watch on your wrist, glasses on your face, a phone in your pocket, right? A Vision Pro at home to do more, a laptop to do even more than that, maybe an iPad for the airplane.
Well, if you're buying the glasses, why would you need to buy the Vision Pro? Is it that much? Would it be that much better?
Well, there would be different use cases, right? The glasses would be augmented reality only product. It wouldn't be all encompassing. It wouldn't be extraordinarily immersive like the Vision Pro is, right? So if you need to sit down to watch a movie, you're going to want to use a Vision Pro versus AR glasses. The other thing is computing performance, right? The glasses will have enough performance that has to balance enough to have proper battery life, right? So you would wear those throughout the day. But if you want to get real work done, you need better performance to do photo editing or video editing or to watch a 3D movie, you're going to need the Vision Pro. So they are two distinct products.
And Mark, as you know, Tim Cook and Mark Zuckerberg are hardly best of friends. Do you see Meta and Apple being bigger competitors with each other in the years to come?
Absolutely. I think that Meta has taken sort of the Android and the Google role in this, XR world. Android has not shown their XR version yet. I expect them to do that this year at the earliest, by next year, in the beginning of next year at the very latest. But certainly, the big approach that Meta should be taking is looking to license some of their hardware patents, some of their expertise, some of their operating system to third parties and get the Meta operating system and Meta services and platform onto as many third-party devices as possible, just like Android did with their smartphone approach. And Apple is going to continue to release their own first-party devices and create everything, in-house. So yeah, I certainly see them in a battle for years to come. Meta is way closer than Apple to bringing AR glasses to market. Apple is probably 5 years, from now. But the reality is you need to balance high-quality displays, processing performance, and battery life, and that takes time. And Meta has simply just, been at this a little bit longer and more extensively than Apple. Apple, obviously, their headset launched a decade nearly after Oculus, which Meta acquired to build its Quest devices. So, but at the same time, Apple's done pretty well for a first-generation product.
There's two dimensions to this story that I'd love to continue discussing. One I know Lisa's interested in, and it's data, how Apple manages that story against, say, a Meta. The other one, and you alluded to it, Mark, what has happened to Google as a company, to Alphabet? Why aren't they at the forefront of these conversations in a way that we would have imagined they would be a few years ago?
Yeah, the Google question is certainly an interesting one. It is a head scratcher. They had such a stronghold over the smartphone market with Android, and it is a big, colossal failure for Google. I think that they completely missed the boat on an augmented reality or virtual reality or mixed reality operating system. They worked on it for many years. They were really at the forefront of this, but they've really missed out. What they really needed to do was sort of create this XR with Samsung on a mixed reality headset for release, I believe, early 2025, that they believe will compete with the Vision Pro. But at this point, I think it's too little too late. Their best bet, and I don't anticipate this necessarily happening, is figuring out a way to partner with Meta and going in it together with Meta, because they are so behind at this point. Now, one fun fact is that the Meta XR operating system is based on Android. So a lot of the underpinnings are there. It's just about how they decide to bring such a partnership to market. And in terms of data collection, the interesting thing about Apple is that what you're seeing on the device is kept on the device, whereas we're not sure how Meta is handling that data.
Hey, Mark, I've got to go. Fascinating. Thanks for getting up early on the West Coast. Mark Gurman there of Bloomberg on Apple and the latest in tech. Coming up tomorrow, don't miss this, Katrina Dudley of Franklin Templeton, Guy Ba of Jenny Montgomery Scott, Dana Peterson of the Conference Board, and the CEO of Tanga Factory Outlook Centers. From New York City, this is Bloomberg.
Politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything.
Part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger. but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. You know, I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California in San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. This is a promising area.
Thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Ferro. So as Cathie Wood sells into the rally on chips and hedge funds lighten up on tech, are you left behind? We'll debate over the next hour. Countdown to the open begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Show stocks prevaricate ahead of a busy week for economic data. Earnings season marches on. U.S. retailers take up the baton. And Donald Trump tightens his grip on the GOP after taking South Carolina. We begin with the big and only issue in the world. Is big tech reaching a tipping point?
It's very much a sort of late 90s type market where we're very excited about the future, and there are a limited number of companies that really represent that future. I'm not the only person to have looked at NVIDIA and be reminded of Cisco in the late 1990s. And, that was the beginning of the internet revolution. People did not overestimate how important the internet was going to be. And I suspect that's the case with AI. But markets tend to step ahead of long-term technological change.
Joining me now to discuss the long-term technological change, the impact on inflation and technology, Samir Samana of Wells Fargo and JP Morgan's Priya Mishra. Good to have you all with me this morning. Samir, let me go to you first of all. Cathie Wood lightens up into the tech rally. Apollo Torsten Slok says to me, the current AI bubble is bigger than the 1990s tech bubble. So are you fearful or greedy? Good morning.
Yeah, I mean, look, it's hard to see this as a bubble. I mean, when you go back to the late 90s, you had, long rates kind of in the 6% plus range. You had corporate bonds on the investment grade side, yielding close to 8%. You had earnings, equity risk premiums close to negative 30%. Now, again, are valuations inexpensive? Are they cheap? No, they're probably close to fair value, maybe even a little bit, above. But the market has provided you a lot of opportunities, the most notable being, October recently. So I think you just have to look for those opportunities. It's just, I wouldn't get too carried away with the bubble nomenclature.
Okay, Priya, good morning. Good to see you. I had Mark Hafley with me this morning. Again,
very restrained, one of the biggest wealth managers in the world, with an appetite for bonds, with an appetite for equities. So good morning to you. Can you update me on your risk appetite as we start the show?
So I think, if you look at the macro backdrop, we're in a soft landing. Growth data has been solid. Inflation, now it's not a straight line down to 2%, but a lot of the inflation indicators are heading close to that Fed 2% target. It could be a bumpy road down, but we think the disinflation factors are still there. So what's underpinning the soft landing, which actually is very positive for risk assets, despite what's happening on the valuation front, is the fact that if the economic data remains strong, and inflation continues to head closer to 2%, and importantly, the Fed, it's a question of, when, not if. The Fed is still talking about rate cuts. All that is a very positive risk environment. But I would say you have to be careful, think about the tail risks, owning some treasuries at some point, especially given how much those cuts have been pared back, is a nice way to hedge. What if things do worsen a little bit? Having some inflation protection. What if inflation doesn't head as quickly to 2%? So I think, I'm positive risk assets, but I'm absolutely looking for ways to hedge those tail risks. And I think we do have opportunities in the macro space to sort of do that right now.
And I know that your jumping off point, Priya, is that negative correlation between Treasury and risk assets should reassert itself when the Fed begins to cut rates. Let me just dig in again on the frenzy that we have had. This is what Warren Buffett has said about markets. Markets now exhibit a far more casino-like behavior than they did when I was young. Yes, I was young as well one day. The casino now resides in many of the homes and daily tempts the occupants. So, Samira, to you again, no sign of a casino-like situation. How would you be prepared to hedge any of the frenzy, if at all?
Sure. So I think much of the casino-like behavior really does come in when you've got things like 0 days till expiration options and, a lot of the leverage funds that you have out in the space now. Basically things that give investors, implicit leverage without, outright trying to figure out options and those types of things. So I think the tricky part there is I don't think people appreciate what could happen if those kind of go in a wrong way.
Yeah.
And, a little bit to Priya's point, I mean, look, the soft landing, in our opinion, is a mirage, right? Which we're probably going to have either is a no landing type scenario where inflation remains sticky and the Fed may not be able to cut it all, or you end up in a situation where really there is a little bit of a harder landing kind of already afoot, and it's kind of being masked over by some of the larger cap tech stocks doing really well. And we're kind of in the latter camp right now. And so from our standpoint, this is not the time to play offense. We would be playing, kind of bonds over stocks. We think there's some good value there, at least on a relative basis. And then within, equities, we would be favoring larger cap, higher quality areas. We particularly find industrials, materials, energy, and healthcare to be really good values right now.
Okay, so those are the trades as we go into the second trading month, or the end of the second trading month of the year. I'm very nearly at the end of the first quarter. Well, traders are gearing up for a busy week of data. The Fed's preferred inflation measure will be the key focus. Mike McKee is with me. PCE, take me through the estimates. Mike, good morning.
Good morning, Manus. Well, if this is all a casino, we're sort of like with a roulette bet felt today, because there's a lot of places you could put your money coming up this week. We get some indication about how strong the economy is with both business spending on Tuesday and consumer spending on Thursday. We get consumer confidence numbers, Michigan sentiment numbers, and we also get the PCE inflation numbers, and that is, as you said, Manus, going to be the big number of the week. I take you back a couple of weeks to CPI. CPI came in stronger than expected, higher than anticipated, and that has really bothered a lot of people in the markets. We've seen a big move up in yield since then. Does PCE follow and do the same thing? Now, as you can see, it runs a bit lower than CPI, and the Fed watches the lower number, PCE. So it's going to be very important which way this goes in terms of how Wall Street's going to be thinking about what the Fed might do. Speaking of thinking about what the Fed might do, it's also time to start paying attention again, maybe, to Fed officials. We got a lot of Fed speak this week, including a lot of people on Thursday and Friday who could be reacting to that PCE number. But again, I want to point out to you the bottom there. Jay Powell speaks next week, March 6th and 7th, his Humphrey Hawkins testimony. That's really going to be the thing that people focus on. One other thing we will focus on this week in terms of the economy is the possibility of a government shutdown. It's something that Wall Street tends to ignore. You can see all the red dots on this. That's when we've had government shutdowns, and it doesn't really change the stock market, consumer confidence, or GDP. You can see the last one there in 2018-19 had virtually no effect. So it'll get a lot of publicity, but it's unlikely to matter a whole lot in terms of all this other stuff going on.
As Anne-Marie Hordern said to me this morning, Mike, welcome to America, lastminute.com on the agreements. Mike, thank you very much. Mike McKee on the data and the slate for the rest of the week. My guests this morning are Samir Samana and Priya Misra. Priya, to you, to a certain extent, we've been jolted by CPI, guided a little bit higher by PPI, told to disregard. I mean, any message you want to take. My question to you when you look at the bond market, the backup in yields, is the bond market now prepared for a slightly piquant in the PCE and a slight trending higher on the 6-month basis? Are we geared up for that? Are we priced for that? Priya?
I think we are. Yes, we've had a pretty big backup in rates. I mean, you look at the amount of cuts that were priced in. The market was pricing in the first Fed rate cut in March. That's been moved out to June. The total amount of cuts this year has gone down. Even that terminal rate, something that we focus on is what's the total amount of cuts. I mean, we can debate whether it's March or June. What's the total amount of cuts being priced in? That's also gone down. That terminal rate is closer to 3.75 rather than 3% a few weeks ago. So I think the market's seen the inflation data, has extrapolated to a 0.4 PCE. But here's the tricky part. We're looking at second place of decimal. If it comes in at 0.5, there's absolutely more room for rates to rise. But I think the market has understood inflation may run a little bit higher or hotter than the Fed would like and can delay the first Fed rate cut. But I think what I'm watching from the Fed officials is, are they talking about hikes? There's absolutely no talk of bringing hikes back on. It's just about when do they start, how much do they cut? And I think if that's the message, no urgency to cut, but we're still on the cutting path, I think the bond market's priced that in well. We've repriced the start as well as the end point of Fed rate cuts. And so you get a 0.4 this week on PCE month over month. And I think that month over month number is important. Year over year, there's base effects. But I would argue January data is often very hard to read. December, January, you've got weather distortions, seasonal distortions. But the market still reacted a lot because this Fed is very data-driven, data point-driven, I would argue. Every data point matters in terms of when they start. The market's heard that, has repriced. So you really have to get a 0.5. Rounded up 0.5 that I think can move the market some more. But we're pretty positioned here for that 0.4 number this week.
Larry Summers has a lot to answer for, doesn't he, in terms of raising the tail risk of rate hikes, although you can channel your inner late 90s redux. Samir, you talk about a defensiveness, and that's where we left you on the equity argument. To dovetail the portfolio, Priya talks about this reassertion of the negative correlation between bonds and equities. You want to be defensive in fixed income. How? Where?
So we want to favor the short end of the curve, at least right now. If rates were to find themselves on the long end back 4.5 or higher, I think we would revisit that. But we just recently took off a pretty nice trade to neutral. We had been most favorable there. So really kind of focus in kind of the short and the belly of the curve for now and look for opportunities kind of on the long end. We wouldn't reach for credit at this point. Spreads are very tight. We think valuations there aren't all that great. And probably the biggest risk to all markets, not just fixed income, is that inflation lives somewhere in the 3% range, which doesn't allow the Fed to have a lot of flexibility going forward.
That lack of flexibility, Samir, what does that translate to? Because the market has been brought, I use the word brought to heel. It's a hunting terminology. But of course, the hounds in that respect have been brought to heel. Those bond traders have been brought from 150 basis points of cuts to 70, 75, 80 basis points of cuts. Does that have any impact on the trajectory of equities? I've got UBS upgrading equities to 5,400 this morning. Number of houses upgrading equities by the year end last week. So does a 3% inflation and 3 rate cuts meaningfully mar the equity rally?
It doesn't meaningfully mar it from the standpoint of pushing it lower, but I do think it acts as a pretty soft cap in terms of where you can really push valuations. And again, I go back to industrials, materials, energy, and healthcare. These are much cheaper sectors where you've got some decent earnings growth and you've got room for multiples expand, right? If you're an equity investor, you want kind of both barrels going at the same time. And I think that's where you just don't have that anymore on kind of the high growth stocks. Unfortunately, valuations are probably towards the upper end of the range.
Bria, just as I listening to that conversation, one thing that I did want to get a concept from you. We've had this back up in yields. That's nice. That's rich. I pick up some duration. I'm curious to know how you look at credit at the moment and sort of longer dated corporate bonds. I was looking at one thing. It's this in the chart. Longer dated debt on the corporate index has gained 4 times that of the shorter end. And so as we see this equity wave rally, you know, you've had this ride higher in the equity market. Are you significantly or substantially tempted to long-dated debt in the corporate market, given its outperformance relative to the short end?
So I think when we look at the credit market, there's a spread argument, spread curve argument, which you're talking about, long-end spreads versus front-end spreads. Then there's a yield curve argument. A lot of people that look at corporate bonds look at all-in yields. I mean, you're getting 6%, 6.5% in long-end yields. That's attractive, and that's why money has continued to pour into total return funds or credit funds. And I think that all-in yield argument is still powerful. I mean, spreads are at the tighter end of the range, but I think for good reasons. Companies did, which was very prudent, fiscal management should have argued. They all locked in rates, so there isn't a ton of issuance in the long end. There's still that $6 trillion sitting in cash that the moment the Fed starts to cut is going to start to come in. So spreads are tight, but I think there's carry in those spreads. So I like, across the curve corporate. I mean, we are looking for opportunities when you get that spread curve steepening or you get some concession. Those concessions are also not very high, but you start to look into where do we pick up that carry, pick up that yield, because these are attractive all-in yields. And there's a lot of money that cash is not a strategic asset. As that money starts to come in, we think corporate bonds will benefit. Maybe less spread performance, but there's absolutely room for those all-in yields to come down.
Okay, well, we'll keep an eye on that. There's still cash destination people like myself that have got to make up their minds where to go. Samir, Priya, stay with me. We've got a little bit more work to do. Joining me now to take a look under the hood, ahead of this opening bell. If you're waking up, of course you want to know what the price of NVIDIA is, but there are other things in the world. Abigail Doolittle can encompass them all. Abby.
Well, there may be other stocks outside of NVIDIA, but we're going to start with one that is linked and trading higher, not surprisingly. And I'm talking about Micron. The chip maker is higher by about 4.5%. So a really nice pop as they have started to ramp up the shipment of a key addition, yes, to NVIDIA's new AI-focused chips. So basically riding along with the AI chip winner move higher, higher, higher. Berkshire Hathaway up 2.2%, very solid result. The stock right now heading to a record high into the open. If it opens at these levels, they did announce a cash hoard of a record $167.6 billion. This on a scarcity of deals. And then finally, not to the moon, well, at the moon, but on its side, Intuitive Machines, the stock down 24%. The spacecraft company said its lander, Odysseus, which has successfully touched down on the moon last week, likely landed on the side. Initially, they thought that it landed upright, but they're saying that that was faulty data. The stock into today, Manus, up 275%, so giving just a little bit of that back.
I won't be singing Fly Me to the Moon this morning. Abby, thank you very much. That's disappointing news if it is proven. Abigail Doolittle on the stocks. Coming up in the show, it is a busy week for retail earnings.
The consumer is under pressure, absolutely, and they are turning to credit cards. We have an outstanding balance of over $1.1 trillion, but we also have to put that in context of the health of the household balance sheet.
Macy's, Lowe's kicking off the numbers tomorrow right here on Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
The consumer is under pressure, absolutely, and they are turning to credit cards. We have an outstanding balance of over 1.1 trillion, but we also have to put that in context of the health of the household balance sheet. Because during the pandemic, we weren't just buying Pelotons, we were also paying down credit card debt. So while I'm certainly not advocating for the consumer to take on more credit card debt, the balance sheet does have additional wiggle room.
You got the wiggle room. A growing chorus of economists saying the consumer is trading down. Now, we will get a clearer picture this week when we get the retail earnings. They're going to continue to roll in. How weak is consumer spending? Will it weigh on the names like Zoom and Dell, but give a boost to the discounters like TJ Maxx? Katie Greifeld is with me this morning. So this is the last innings of the report card. Katie, how important is it for the retailers?
Well, we have three retail names to focus on here. So let's start with Macy's. Sales projected to fall 1.9%. That would be the seventh straight quarterly decline. But when it comes to Macy's, a bit idiosyncratic since a lot of focus will be on activist investors. Arc House Management's bid to buy the company. Definitely keep an eye out for that one. Lowe's also reports on Tuesday. And we know that Home Depot's earnings didn't go over too well. Could be a similar story here because same-store sales expected to dip by 7.1%. That would be a fifth straight quarter of declines. And that's as shoppers continue to dial back on their discretionary purchases. Of course, that isn't just a Lowe's issue. But then we have TJX, like you mentioned. And this will be interesting to see whether consumers trading down has been benefiting the likes of TJX. Analysts are calling for a 4.1% rise in same-store sales, sort of bucking the trend there. So potential good news, Manis. Also, the pace of markdowns has slowed at TJX. So that's your setup, and it starts tomorrow.
I feel my civic duty to get out there and use the credit card to help the great American nation. Katie, thank you very much. Katie Greifeld, setting up the consumer agenda. Samir Samana of Wells Fargo is expecting this. The consumer to, quote, weaken noticeably in the first half of this year. Alongside me this morning to discuss the upcoming events of the week and the impact on markets, it is Priya Misra. Samir, to you first of all, why are we going to falter? I thought the hedonism of the U.S. consumer was impenetrable.
Yeah, maybe at the upper end, but the lower end has been feeling pain for quite a while. And I think a lot of it can be traced back to inflation, right? It's basically been eating away at households' budgets. And, you know, when you look at discount retailers, they've been struggling for some time, unless you've got kind of some of the heft that, you know, some of the larger staples names do. You know, a lot of the smaller names have kind of fallen back. And it's one of the reasons why we're unfavorable on the consumer discretionary sector. We're also unfavorable on real estate. That has both to do with the fact that there's probably too many retail locations, and you're going to have commercial real estate be a little bit of a tricky spot to work through in the next recession, which we think is possible in the next couple of years because we think it's late cycle. And then we recently downgraded financials. When you think about consumer credit, when you think about lenders, they probably will also have to kind of up reserves for the consumer, which is starting to feel the pinch.
Priya, can I close off with you? You say it is too early to say with any conviction that the lower trend in inflation is gone. Now, if you see a material trade down, slowdown in retailers at the coalface, in these numbers. How does that play into that narrative for you? Will that reinvigorate the potential markdown, price down, slowdown, disinflation narrative?
I think it will, because to the extent pricing power for these retailers has gone down, or the fact, does that start to impact margins? Does that start to impact how much they hire? I mean, I think what's underpinned the soft landing and the low inflation narrative is that even though the labor market remains tight, wage inflation has started to come down. And as that continues to fall, I think that's going to bring that inflation narrative back closer to 2%, which then allows the Fed to cut. So we're absolutely looking at these retail earnings. I think to Sameer's point, the household sector, you have to look at the distribution. The lower end consumers and households are struggling. Those savings have come off, and real incomes have not grown as much. So, which is why if you look at delinquencies, they are picking up at that lower end. Does that crack start to deepen out? And I think that if we see signs of that, I think the market is going to get nervous about the soft landing narrative. And bonds are priced for soft landing. So I think that's when treasury rates have room to come down. It's one of the reasons why we like owning these 5-year treasuries. Because if you start to see signs that maybe the consumer is slowing, maybe not to recession levels, but slowing more than what's priced in, I think the Fed has a lot more room to cut at that point, and no market's really priced for that. So I think owning risk assets into these earnings, along with some treasuries, will give you cover in case we do start to see either that trading down, which is not a great sign for the consumer, given how strong the labor market is.
It is the perfect entree and main course. Priya, thank you very much. Priya Misra, Sameer Samana, my guest this morning on markets, setting the agenda for Monday morning calls to come. Tony Dwyer will join me with his view on markets.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Time for your morning calls and what the analysts are saying on Wall Street. First up, HSBC downgrades Moderna to reduce, seeing multiple headwinds to growth and revenue estimates. JP Morgan upgrades Gap to neutral, highlighting the company's new leadership and improving inventories. And finally, Argus downgrades Newmont Mining to hold, expecting limited upside with gold prices already trading near the record high. Coming up, Tony Dwyer joins me from Canaccord Genuity, joining me after the opening bell, I should say. NVIDIA trades higher this morning. We've had 13 records in a row in 2024 in the SPOOs, and we endure.
there's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Psychology, 5,100, a lovely round number. Golub over at UBS says 5,400. The wealth management team said 5,500. They're happy on the NASDAQ. Again, NVIDIA trades higher. You see Kathy Wood selling into some of the strength on her TSMC position. Right now, we're poised for an update. It's razor thin. It would be, again, another day. If we hit another record, it would be the 14th record high. Russell 2000, slightly less skeptical. Look, they've got ticker tape and everything over at the NASDAQ today. So these equity markets are set for a little bit of a better bid tone. We're going towards PC, personal consumption expenditure later in the week, a raft of Fed speak, and of course, quite a significant bond auction through today and tomorrow. Treasuries are flat at the moment to tick higher. 425, we just have Priya Misra with us. You want to be long, a little bit of duration here. You're seeing money flow into credit. The view from Barclays is it's going to be a fairly significant flows. Oil was down 2.7%. We did that on Friday again, further and lower, down by 0.4%. U.S. production up by 1 million barrels between January and February, now 4.8 million barrels. And the euro dollar, euro up 0.25%. The dollar breaks trend for the first time this year. We saw a little bit of a weekly drop last week, the first loss of 2024. But stocks, they have it. And Berkshire Hathaway has it all. The company on track for an all-time high today after the cash pile hit another record. Abigail Doolittle is with me. Having that much cash comes with a message from Warren Buffett. Abby.
It does indeed, that there could be a significant opportunity ahead. But before we get to that, let's break down what we have going on with the stock, because it is up for an 8th day in a row, the longest winning streak going back to April of last year, plus opening at a record high. So investors are really liking what they see. And it's not just about that cash pile. It's also about the fourth quarter operating earnings of $8.48 billion ahead of last year by 28%. That's tremendous growth. Last year, that number came in at 6.63%, or $6.63 billion, excuse me. And it was helped out by an increase in insurance earnings and investment income amid higher interest rates and milder weather. Now, as for that cash pile, what we're talking about here is massive, $167.6 billion. And yes, Warren Buffett saying that this is amid a drought in deals. If that changes, he essentially said if there are more deals, the firm would have a shot at quote-unquote eye-popping performance. Well, given the fact that this is a behemoth already, 28% growth, that's already eye-popping. So it'll be interesting to see what that could mean. And interesting, not just the record high, Manus, also inching to that $1 trillion market cap.
Yeah, big round numbers, isn't it? Abby, thank you very much. Let's turn our attention to tech. Amazon replaces Walgreens in the Dow Jones Industrial Average. That's after the announcement last week. Ed Ludlow is with me this morning. History live and in the making for Amazon and the Dow. Ed, good morning.
Yeah, good morning. And investors cheering that history somewhat. Amazon higher by 0.5 or 0.3%, fluctuating post-open. As you know, the historic Dow index is weighted on a share price basis, Manus, rather than a market capitalization basis. So Amazon is replacing Walgreens Boot Alliance. The catalyst that precipitated this was actually Walmart doing a 3-for-1 stock split, and the kind of chain reaction effect is that Walgreens drops out of the 30 stock basket. What caught my eye and I found interesting is in the press release, S&P Dow Jones indices say that the action is reflecting the evolving nature of the American economy. This change will increase consumer retail exposure as well as other business areas in the Dow Jones Industrial Average. I think we'd agree, right, Manus, that even though it's kind of more than a century beyond its founding, the Dow Jones Industrial Average is just not the same benchmark it once was. And you now look at Amazon as a constituent. If you're a Bloomberg terminal user, go to the Indu stock ticker or index ticker, do MEMB, and you'll see that change reflected in there as of this morning. But then think about the names that are missing. You know, the Dow Jones Industrial Average did trail the S&P 500, the NASDAQ 100 last year, and a big part of that being that many of those mega cap tech names that I'm so focused on are not a part of it. Apple's in there, but Meta and Nvidia are not, for example. So this was announced after market close last Tuesday. I was on vacay, so for me it's fresh, and it's a bit of market history news for you this morning.
There you go. We'd like to mark time. Ed, thank you very much. Ed Ludlow on the changing complexion of the Dow Jones Industrial Average. Let's have a quick snapshot at commodities. U.S. aluminium producer Alcoa made $2.2 billion. That was an offer to acquire the Australian joint venture partner. Simone Foxman is with me. She has the details. The stock is a little bit lighter this morning. Simone, what's the deal?
Yeah, it seems to be a typical acquirer target dynamics here with Alcoa shares now down close to 3.5%. But Alcoa making this offer for Alumina Limited, that's an Australian company. But the key reason that it wants to do this is the sole asset of alumina, which is called Alcoa World Alumina and Chemicals. Alcoa already controls about 60% of that, but this is a key producer of 10% of the world's alumina production. That's a semi-processed material that goes into making that ultimate aluminum product. Alcoa already owns 60%, and this an offer for a 13% premium to Alumina's share price on Friday. It's been actually trying to buy this company for quite a while, but now we get the actual board of directors really saying go ahead with this transaction on the target side. Morgan Stanley says that means the stars are aligned for this deal to go through, but Citi says investors should be questioning some of the tax benefits and regulatory benefits that Alcoa is going to get. We know the price of aluminum is down about 45% since hitting a peak in March 2022. But the message here from Alcoa is we think that that is going to turn around based on the demand for aluminum coming from the electrical vehicle space, coming from solar, wind power space, and the CEO there talking about being able to accelerate strategic decisions after this acquisition, Manus.
Simone, thank you very much. We'll talk about acceleration. NVIDIA is bid this morning after the opening bell. Cathie Wood is actually selling into this NVIDIA frenzy, cutting her stake in TSMC, as I said, for the first time since 2021. What to do with the tailwind? Katie Greifeld is here with more on the story. Katie, good morning.
So these sales, they happened in the ARC Autonomous Technology and Robotics ETF. The ticker there is ARCQ. She sold 8,600 shares of TSMC on Friday. She also sold shares of key TSMC customer NVIDIA. But it's important here that when it comes to Friday's sales, they don't necessarily reflect new views on the part of Cathie Wood. Of course, ARC's ETFs, they rebalance frequently to keep their holdings in line with portfolio weightings. And we know that both shares of TSMC and NVIDIA have really been going up and to the right, pretty much straight up over the past few months. So ARC likely selling these shares to get back in line with portfolio weightings. When it comes to ARCQ, that's around 2 to 2.5% of ARCQ. So rather than a new fundamental view there. But that being said, this of course does trace back to Cathie's views on NVIDIA. We know that she has been vocal that AI will be a game changer, but she's been selling NVIDIA throughout really since last year. And her view there is that she's doing that in favor of going after some less obvious AI names. As a result, she's missed out on some monster NVIDIA games. We know the company was up 238% last year and already up 59% this year, Manus.
Yeah, it's just a juggernaut, isn't it, Katie? Thank you very much, Katie Greifeld there. Let's stick with that AI craze, because the current bubble is more overvalued than the tech bubble in the mid-1990s. That's according to Torsten Schlock of Apollo. This is a chart which Danny Berger and I used this morning in Bloomberg Brief. Tony Dwyer is Chief Market Strategist at Canaccord Genuity. Now, a number of voices are going to fight back at bubbles, and this is like the 1990s. Valuations are different, earnings are different. It's different this time. But when you look at that kind of comparative, it is quite a heady market at the moment, isn't it, Tony? Good morning. So we're going to come back to Tony in just a moment. I think we've got a little bit of a volume control problem there. We'll just come back to Tony in a second, just to take you through some of the momentum in these markets. You're looking at equity markets this morning. We've had 13 record highs in a row. NVIDIA is worth $2 trillion. Goldman Sachs say the hedge funds are unloading tech at the fastest pace in 7 months. We can return to Tony Dwyer at Canaccord.
Sorry about that.
Not at all. It's live TV. Stuff happens.
Yes. Oh my goodness.
Not at all.
So,
look, I'm taking the bid. I'm asking
earlier.
you about the offer side of this trade in tech. So can we square the bid and offer?
Well, it's a historic level of weighting for the top 10 stocks as a percent of the market cap in the S&P 500. Manus, it's not just NVIDIA, it's the top 10 stocks. And when I got into the business in the late 1980s and into the early 1990s, the main decision among active portfolio managers is, why would you use the Dow Jones Industrial Average because it's too weighted to just a few names? Why not use the S&P 500, which is more representative of the many names? And I think we're having that same discussion now. Of course, it's surrounding NVIDIA, but it's not. If you look at SMCI, that is currently accounting for more than 200% of the gain in the Russell 2000 year to date. I believe the Russell 2000, according to Bloomberg and the HMOV function, you would be actually down in the Russell 2000 year to date without that one stock that actually is nowhere near a small cap stock. So I think what we have to do is not just look at it as NVIDIA, but how the major indices that we track performance are calculated. And at this point, as I've been saying for the last 6 months, I think it's inappropriate. We're much more skewed to the equal weight.
We're going into the last gasp of understanding what's going on with the balance sheets in tech, which we've had. They're healthy. We're not going to find out about the consumer this week, and I'll ask my last couple of guests this. We've got Lowe's and we have Macy's tomorrow, and we're following on through the rest of the week. How do you look at this as being an important definition of that sector for you for the rest of this year?
Well, you know, the farther we go where the Fed is higher for longer, the steep that the cliff is going to get. In other words, the cliff of debt that's going to roll over, whether it's commercial real estate, consumer debt, or corporate debt, the farther we go with the higher rates, the more likely that debt is going to have to be refinanced or issued at a much higher rate than companies, households, or individuals are or the government is expecting. So it's almost like it created this zombie-like environment where the private capital that's moving into the market, which is historic. I mean, man, it's $1.7 trillion in private credit, which is up from about zero 10 years ago. And just in the last little over a year, you're up about 800 billion. And I think people like me and macro folks may have missed that when every indicator that I've ever looked at said we should have had a recession, and we haven't. And I think the reason for that is there's a source of capital that didn't exist before, and that's keeping the economy alive. But it's not robust because as the consumers have to pay that higher interest expense.
Can you fight against that? Can you fight against that? We've got Colin Kelleher warning about governance in that area. That was his message at Bloomberg House in Davos. He warned about, you know, physician, heal thyself. Stop looking at the banks. Stop trying to raise our capital, which is every good banker should do, is to fight back against that. And then he said, you know, throw these other guys and girls under the bus, which is private credit.
But how do you do that? So let's look at how you get, this is a really important topic, and I don't think that's talked about enough. If you're a bank, you have a cost of capital. You have the deposit rate or whatever rate you're raising money in the open markets, whether it's credit or equity, right? That's your cost of capital. That's why when the yield curve inverts, bank lending shuts down, and it did. The traditional things worked. In private credit, you're paid to take the money. You don't have that cost of capital. Pension plans and endowments are paying you typically 1% to 2% to take the capital, which means you can take a higher risk in a different or difficult economic scenario. That's why they're getting the market share, and I think that's why we've been able to avert a recession. The key question will become when all those private equity and venture firms have to roll over that debt as we get closer to the rollover cliff, it's going to get steeper as long as those rates remain so high.
Is that the accident? Is that the precipitous moment? Is that the turning point in the flags, the red flags of a material slowdown in USA Inc.?
I think we're already in the material slowdown. A couple of your prior guests were talking about that. When we come on TV and we talk about bull market, we talk about the S&P 500. If you look at the McClellan Summation Index, if you look at the NYSE Advanced Decline Line, the Transportation Index, if they've done nothing over the course of this year, they're still working off the extreme overbought for last year. So I would encourage people to walk away from the black or white. In other words, it's going to zero or it's going to $1 billion. How about if we just have a normal credit cycle as interest rates stay too high for too long? Because the Fed does it every cycle. This isn't new news. They were too low for too long. So the odds that they're going to get this exactly right on the upside, I think, is a little bit challenged.
A very frank and candid proposition there, Tony. Say it the way that it is. They overreach on the downside and they just overextend for too long on the upside, and then something breaks. Tony, thank you very much. In private credit, you've raised the alarm bell. Yourself and Colin Kelleher can grab a lunch. Tony Dwyer, Canaccord Genuity. My guest this morning on the markets. Next up, we're going to talk politics. Nikki Haley suffers a crushing loss in her home state.
I'm not giving up this fight when a majority of Americans disapprove of both Donald Trump and Joe Biden.
We'll have the details on the future of her campaign next with Anne-Marie Horder.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
There are huge numbers of voters in our Republican primaries who are saying they want an alternative. I'm not giving up this fight when a majority of Americans disapprove of both Donald Trump and Joe Biden. We're headed to Michigan tomorrow. And we're headed to the Super Tuesday states throughout all of next week.
Battling on, Nikki Haley there, seemingly defiant despite sweeping losses to her rival Donald Trump. Haley secured less than 40% of the vote in her home state, still vying to stay in the fight, even though her major donors, including Koch brothers, have pulled their backing from her campaign. Next on the agenda, Michigan. Heading to the polls tomorrow, Amy Hordern joins me now to dissect the defeat and project to Super Tuesday. I'd love to be on the road on this one, do you know that? I know you would. But talk me through her defeat, the withdrawal of her backers. Why is she still going?
Well, she's going to go through March 5th, which is Super Tuesday, and then potentially there she'll have to recalibrate and see where she is with some of the campaign funding. You know, you have the Koch brothers Political Action Committee saying they're going to take stock of the situation right now, and they still personally want to support and endorse her, but money-wise, they're going to look more down ballot and try to go after some of those key Senate and congressional races where potentially they can get conservatives in, because we've seen a lot of donors really back Nikki Haley. I think what's so interesting about South Carolina, Manis, was really two things. One, Trump obviously dominated with 60%, but also you saw the division within still the Republican Party. Of course, he has the base, but when you look up to November, he still does not encompass the entire party. She's still getting close to 40%. And if you look at the Fox voter analysis, 6 in 10 of those voters say that voted for Haley say they never want to back Trump. So I think what you need to remember is, yes, he's dominating right now, is he's on path to be the nominee, but the steep climb he may have to overcome if he wants to win the general election. How does he get the remainder of the Republican Party that currently likes Nikki Haley?
You've also got to say he won more women and men of all age groups, suburban, urban, and rural residents, both white and non-white. She picked up on the educated, degree educated, which is a fine differential to have, but it doesn't win you the nomination.
Not in the primary, but what she keeps constantly reminding people is that look at her versus, say, Joe Biden in a general. And she says, in a general election, I would beat Joe Biden. And she hammers home what a lot of Americans you see repeatedly in polls say. They do not want a rematch of 2020, but it looks like we are going to get a rematch of 2020.
Very briefly, you correctly said, welcome to America, when we talked about the potential for a government shutdown earlier this morning. Contextualize for me, 3 days to crisis?
Well, March 1st at midnight, potentially, we could see some government agencies, because they split up the government shutdown potential. One maybe starting after March 1st, one March 8th. I would just say, don't worry about anything yet until we see how the meeting Joe Biden has called. The President of the United States was in New York today, but tomorrow he's going to have McConnell, Schumer, Speaker Johnson, critical, and Hakeem Jeffries at the White House. They're going to discuss potential government shutdown, how to get an agreement across the finish line, as well as foreign aid. So let's read the tea leaves after that meeting.
The art of the deal. Cup of tea. in the White House and see whether you can avoid shutting the entire country down. Anne-Marie Hordern, thank you very much for that. Let's get sector price action. Abigail Doolittle is with me throughout the show as ever. Abby.
Well, we have stocks basically fluctuating, that S&P 500 up slightly, but we do have more sectors higher than not, so there is some breadth to this tiny gain or this fluctuation. Up top, consumer discretionary, up about 0.5%. Energy flipping into that spot right now, so not a ton of conviction here, smaller moves to the upside. But to the downside, take a look at communication services, down 1.3%. Utilities down 1.2%. This is yields go higher and make the dividends of those utilities, those dividend-rich stocks look less attractive. If we dig in over the last 2 days, because of course we're going to entering a new phase of earnings, and that is retail. We have consumer discretionary and some of the retailers, those indexes up over the last 2 weeks, up about 1.5%. And then over the last 2 weeks, we have outperformance from the restaurant index, Manus. But take a look at Domino's Pizza. They, this morning, reported much better results than expected, the stock having its best day since July of last year. The consumer, it's so interesting, this adds to the debate, apparently spending money for these expensive pizzas to take out and to deliver in another data point about the health of the consumer. Domino's would probably say the consumer is pretty solid, given the fact that those same-store sales are positive.
Haven't seen a piece of pizza in about 20 years. Abby, thank you very much. Carbohydrates. Anyway, there you go. Coming up, market moving events for the rest of your week. The Trading Diary. We'll set your agenda right here. This is Bloomberg.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but this is, my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
This is Bloomberg.
Never mind NVIDIA. Pizza for all my friends. Domino's is up over 8%, but we are looking at green on the screen. We've had 13 record highs in the year of 2024. How close are we to making another one? Tech is on the bid as Cathy Wood decides to trim back her positions on some of the chip stocks. Let's have a look at what we're watching for the rest of the week. Data slate, new home sales at the top of the hour. Then we hear from the Kansas City Fed president this evening. Tuesday, we roll into the retail earnings, Macy's and Lowe's. Thursday, Fed's preferred inflation gauge, PCE, looking for a little bit of a pip higher there. Friday, potential government shutdown deadline. Keep an eye on that. That was countdown to the open right here on Bloomberg. Monday morning, setting your agenda. Green on the screen for equities. Can that endure? Are you brave or do you feel the NVIDIA frenzy? Good morning from New York.
this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Alex Steele, Paul Sweeney here with you. We are talking Bloomberg Intelligence. We focus on companies, we focus on stocks, and we lean heavily on the analysts, the 400 analysts in Bloomberg Intelligence. They cover 2,000 companies, 130 industries. We lean on them pretty heavily as we look at companies and stocks moving this market. Coming up today, we're going to check in with Matthew Palazzola. He's BI's senior insurance analyst. We're going to get his thoughts on these Berkshire Hathaway numbers. A lot of cash there. I don't know what they're going to do with all their cash. Kathy Entwistle, managing director at Morgan Stanley Private Wealth Management, joins us to talk about what's happening in the markets. And Nathan Dean, Bloomberg Intelligence senior policy analyst. He's down in Washington, D.C. I pin all the blame for all the misfunction in Washington, D.C. on Nathan Dean. So we'll have to see what he has to say about it, what's coming up. We got to keep this government open is what I'm told. Let's kick everything off this hour with Mr. John Tucker.
All right, and we're being brought to you by Interactive Brokers Bond Marketplace. Access their vast selection of over 1 million global fixed income securities with no markups or built-in spreads and low, transparent commissions. Learn more at ibkr.com/bonds. We're data dependent, I'd like to say. So let's get right to the data. This is new home sales on a month-over-month basis for January, coming in at 1.5%, a 1.5% increase. That's far below what we were looking for. The survey of economists by Bloomberg was expecting 3% increase. The prior month was 8%. That was revised downward. Still a healthy clip there to 7.2%. After records last week, the major stock averages inching higher this morning. Just a few inches. 6 of the 11 major industry groups in the S&P 500 are higher, led by consumer discretionary stocks. That's where you're going to find shares of Tesla. That was up about 2%. Biggest drags coming from communication services and utilities. Communication services is where you find Google, which is down about 2.4%. Bubble? What bubble? Patrick Armstrong at Plurimi Wealth says AI-related stocks may have farther to run.
I don't expect the steep upward rally that we've had for the last 3 months in these stocks to continue, but the stocks that are the AI beneficiaries have incredible pricing power, incredibly strong revenue growth. They're at lofty multiples, but we think those multiples are deserved.
Right now, the S&P 500 up a point, 5,090 on the index. The Dow Jones Industrial Average up 85 points. That's a rise of 0.2%. The Nasdaq 100 4 points higher. That's up less than 0.1%. Let's do yields right now. The benchmark 10-year yield up 1 basis point. The 2-year is up 1 basis point. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Welcome back, Alex.
Why, thank you, guys.
That was a very long week.
Was it?
Yeah.
I feel like I blinked and it was over.
How was your little holiday?
It was wonderful.
Was there snow up in the mountains?
There was.
Okay,
There was
good.
ice.
Ice.
There was ice and there was snow. I
that's
made some
fun.
donuts. I made an Italian stew. I listened to Paul one day.
Oh, boy.
It was a full service until my daughter
So it was
vetoed
pretty
that
good.
for Taylor
Sort
Swift.
of. It was mixed then.
It was really nice.
All right,
But it is.
boy, markets moving higher. Nvidia.
That's right.
That's kind of what you missed. A lot of technology right at the forefront here. So we'll have to see how we play it out here. Alex Steele, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So go over to youtube.com, search Bloomberg Podcast is, I think, the easiest way to find it these days. A little bit of red and green on the screen here. No real direction here for the indexes, I would say. But let's check out with Nora Melinda. She covers these markets for Bloomberg News. Nora, what are you looking at?
On this Monday morning, I'm looking at Domino's Pizza. Cannot stop thinking about food.
Okay.
Their shares are surging.
Indigestion just happens. Go ahead.
Those shares are surging as much as 9.6% this morning. That's the highest since 2022 and the biggest gain since July. And so this is all coming after its fourth quarter U.S. comparable sales beat expectations. It was expecting, this is really positive, especially as we think about the downbeat reports that we've gotten from other fast food chains like Wendy's and McDonald's. Essentially, the company reported domestic comparable sales that gained 2.8%. Analysts were expecting 2.2%. And the driver of all this is essentially its loyalty program. It also rolled out a third-party ordering service through Uber Eats.
So,
interesting.
Domino's emergency pizza promotion, a twist on the buy one, get one free deal, drove an increase in order counts and signups to the company's loyalty program. Go figure.
All right.
So
my theory is with more people legalizing pot, the stoners go there.
That's a good call there.
That could also be
I
it.
mean, I haven't seen any analysts making that call,
But sure,
You
why
should be the
not?
first.
Or people just
that
like
lava
pizza.
cake, that's just like just made for those people.
But also, maybe they just want to trade down and eat some pizza, and they're good deals.
Yeah, I know.
Or they're all stoned.
But I'm thinking
It's either one or the
Spicoli.
other.
Yes, it's Spicoli, the Spicoli effect. Okay, what else you got for us?
We can't go without talking about Berkshire Hathaway. Those shares are up almost 3%, as much as 3%, hitting $647,000. It opened at a record high. I clearly cannot speak today.
No, it's just really hard to read that price. 'Cause it's
I know.
so bizarre.
It's a crazy.
But these shares are up for the 8th day in a row, and that's actually the longest winning streak since April of last year. The company is on track to set to push the market value of Warren Buffett's conglomerate even closer to the $1 trillion mark. That would obviously make the company the first one outside of the tech sector to reach such a market capitalization.
That's amazing.
And it's the whole thing here is about the cash.
167 billion, right?
Yeah, 160. What do you do with the cash? What can you buy? It turns out not a lot. And
Yeah.
we've been asking this question for years now. We're going to have Matthew Papalazzola, BI's insurance analyst. He's going to come on and see if he's got an answer for us.
Right. Yeah. And of course, we're all looking at this cash pile specifically, but also it is coming after it posted higher operating earnings. That was $8.48 billion. That was ahead of last year by 28%. So it's really that whopping growth from last year, between last year and this year, that investors are really excited about here.
And let's go to the next one because this is a fun one.
Yes.
Well, not for shareholders, but Intuitive Machines, that stock up 26%. What's the story?
Yeah, so it's sinking as much as 29%, on track to lose more than a fourth of its value. And this is a really interesting company here, especially we have it after the spacecraft company, this is a spacecraft company, and it said that its lander, which touched down on the moon last week, likely landed on its side. I don't know if you guys are into space and all these landings, but I find that so interesting. And of course, this company, people were super excited. It was actually up about 350% off of a January low when people were super excited about this mission to happen. But now we have those shares sliding after hearing that it could have landed on its side there.
I mean, picky. It landed, right? I mean, there was no
I'm no rocket scientist, but landing on your side doesn't sound good.
But if there were people, sure, but it still can do its job,
Is it supposed to come back? Do we know?
I mean, that's a really good question here. I think people are more so focused on this.
to take off.
We don't know what it's supposed to do, but it's on its side.
I don't know. Back in my day, John, when those lunar modules landed upright. Back in our day,
we knew how to do it back in the 60s.
Right, but that was NASA. This is a private company, right?
Right. Yes.
I mean, that's why it's kind of a big deal.
Yeah, super
well, it's public, but you know what I
out
mean.
there.
Yep.
All right, Nora?
Yep, Nora, thank you so much. Appreciate that. Norma, Linda, giving us all this, what we need to know in the equity markets. I don't know, I kind of remember NASA, but now you might as well privatize this whole thing.
Yeah, well, that's what's happening. It's basically it's a big business. Like it's going to be about who can do the cheapest thing, and then wind up getting the farthest. Like it's all a commercialization business. It's actually kind of cool.
It is.
Like if you do it like that, you can maybe do it more efficiently.
Yep. SpaceX rocket, I think, is what they used. Is that right, John? I think.
That's interesting.
I don't know.
I think it was a SpaceX rocket.
Well, there's not that many options, right?
No. I mean, I don't think who else.
Blue Origin, you could do, right? You could do a Blue Origin rocket.
But like NASA doesn't have any rockets anymore. I mean, that whole they don't do it that anymore.
Farm it out. That was part of the cost
That's the whole deal.
Yeah,
it's too expensive.
Yep. Berkshire Hathaway. People are talking about this thing getting close to a $1 trillion valuation. Fine. All I care about is what are they going to do with their cash. Matthew Palazzola, he joins us here. He's from Bloomberg Intelligence. He covers all the insurance companies, including Berkshire. So, Matthew, how much cash do they really have on their balance sheet? And we've been asking the same question for years. What do they do with it? Anything new coming out of Omaha?
No. So, about 168 billion of cash. We've been talking about this for a long time. They haven't had a ton to do with the cash. Buffett had said there's almost no targets outside of the U.S. that he would be interested in, and the ones inside the U.S., the prices are getting driven up on competition. So it was a real, I thought, a kind of negative tone in the letter, not only on that, but on some of their operations as well.
So walk us through that. Like what raised concerns for you?
Yeah, so the beginning of last year at the annual meeting, Buffett had said, we think the energy business and the railroad business, earnings are going to be lower in 2023 versus 22. What happened was they were lower, but there was actually a couple of externalities as well that made them even worse, and their go-forward concerns. The first one was labor costs in the railroad, that they were having a labor shortage and they were paying their people more. So the margins in that Burlington Northern Santa Fe seem to be like they're going to underperform peers on a go-forward basis. The second was in energy. In the West Coast, there's a lot of litigation on wildfires. There's a lot of regulation on their profits, and the outlook there didn't look good either.
So, but to that point, what I find interesting is that for the railroad, for example, that's why there's the cash pile, right? Because you can make the argument that I have $167 billion in cash because when things don't go well, I don't have to go to a bank. I don't have to get a loan. I can manage that.
So their cash pile is far in excess of what they would need, right? So they want to keep a buffer of like 20 billion, and they have 167, right? So they're not keeping it to support the businesses. They're keeping it because there's just nothing good to do with it.
Historically, what has Warren said about dividends or lack thereof?
So he likes getting them, and he'll never pay them, right? So I think in a post-Buffett Berkshire, maybe that's something that happens with Greg Abel. I'm not 100% sure, but it's never going to happen when he's in charge.
And that's just a philosophical thing with him?
Yeah, he thinks we can do better with the cash than giving it back to you and letting you take the alternative.
Can I ask a really dumb question? Like, where is that cash? Like, is it in a money market fund? Like, is it in bonds?
It's in money markets, bonds, short-term securities. And what happened last year was the short-term rates went up so much that they were earning a ton of money on it. And I think that actually took, they went from earning like 50 million to like 5 billion or something, just on the cash. And I actually think that took a lot of pressure off even them investing in equities.
So how do people, I mean, you're an insurance analyst, so you're an odd duck to begin with, right? Nobody, it's just
Quacking, right?
crazy accounting. You don't know what's going on. How do you and other analysts really analyze this conglomerate? Or do you just say, hey, it's a GDP growth company and that's it, slap a GDP multiple on it?
I mean, I wouldn't say that. It's tough. We try to look at, some of the parts. You can value the company looking at the float in the insurance business. There's a couple of different methods to do it. Even just on a simple PE, right, and what they're earning. It seems like generally the values of the businesses kind of fall in line with peers. Like, I don't think there's a conglomerate discount maybe anymore. I would consistently argue that it's not a GDP company, that it's got best-in-class businesses, pricing power businesses, so you're not going to just see them growing, 2 to 3% a year. But, a ton of the emphasis goes on their investments and, what they can buy.
What do you think they should buy?
Something I was thinking of over the weekend, I was thinking they were going to buy Occidental, right? And they threw cold water on that last year. He said it again in the letter this year that he wasn't going to buy it. But something I thought kind of fits into his niche would be maybe entertainment, right? So if you think about the things...
There's a lot for sale.
Maybe your old
How's that
stomping
Paramount
ground,
looking at right now?
I think that because, look, what does he look at? He looks at stuff that there's going to be consistent demand for, right? Maybe it's a little old school. Like, he says coal's not going anywhere anytime soon. It's not. He bought these Japanese trading houses, right? The investment there is around $19 billion in value. And if you look at them, they're not AI, they're not flashy, they're not tech, but they are steeply involved in these things that are just not going away. And I think that, I don't cover entertainment, but I think, there you go, Paul. Maybe you have an idea. Call him up.
You're welcome for him.
But
the whole town's for sale.
There's always going to be a market for entertainment. We always need to be entertained. So I don't know. Maybe there's something in there.
Well, I mean, to your Oxy point, I mean, it's not that he was offered a really good deal. Like, he got a really good deal on some shares when Oxy was looking to buy Anadarko, and they needed cash. They needed cash quickly because Chevron was also making a bid. So, like, will things get dramatic enough or distressed enough for there to be a really good deal? Might not be by the whole company, but get that good deal. What do you think?
He always says he would love to own all of the companies he owns. Like, he would love to own Apple, right? But he can't own the whole company. I mean, he does say we're not interested in necessarily running Occidental, right? So I could see them buying up more of it. I mean, they have the warrants that will increase their ownership given the strike price. But I don't. Again, like, they don't want to run it, but I think they would own as much of it as they could.
Step back here. P&C, property and casualty. What's the call here? Do we like it? Do we not like them?
So, for Berkshire's businesses specifically, they leaned into the Florida reinsurance market heavily last year.
Nice.
Okay, and that worked out well. And I've been guilty of saying this, and you see it sometimes in the press that they quote bet on the market, right? They didn't bet on it. They didn't place their chips on black and hope that it worked out, right? It was a risk-adjusted play. They said, if we have an average hurricane season in Florida, we'll still make a nice return. What happened is we had a far below average, so they made a lot of money. The other business for them that's kind of turning around is Geico. So if anyone here drives a car or has a car, you've probably seen auto insurance costs going up dramatically. You've probably also seen a lot less advertising. So they spent, I did some back-of-the-envelope calculations, about $1.5 billion less on advertising this year, just in Geico, than they would on a run rate basis.
And why was that?
They did that to protect the profitability of the business. So the combined ratio of the business is kind of the inverse of their profit margin, right? They hope to make about a 4% profit margin underwriting insurance. They were probably going to make zero if they didn't cut their ad spend dramatically. So they cut the ad spend. They've cut policies too, specifically on the West Coast, to kind of pare that down. So that business was actually a nice performer this year, but because they spent a lot less money on advertising.
Really interesting.
That's
Thank
less
you.
money on my companies.
Yeah,
that's
stuff.
not good. Yeah.
Sorry about that. Matt Palazoa, we appreciate it. Thank you very much joining us from Bloomberg Intelligence. He's the P&C Insurance Senior Analyst there and also covers all things Berkshire Hathaway. I do like the new Geico commercial, though. Have you seen this one?
Which one is this?
It's the one where he's like kind of a movie star and he's like really good. He's not a movie star, but he works really hard and all his colleagues
lizard.
who are humans. Yeah. Well,
Or the
all
gecko,
yeah.
whatever it is.
Gecko.
All the colleagues are really jealous because he does everything so well. No?
It's a heavily advertised.
It's just me.
It's a competitive space, and they had. I think the insurance.
Sounds
guys,
like a really good vacation
Yeah.
you had, watching TV, listening to Paul.
listening to Bloomberg Radio. Well, you're up into the Berkshires. I mean, there's not a lot to do.
Yeah, and I don't ski.
Right.
I bake donuts and I watch TV. I mean, that sounds good. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Green on the screen, just barely, after last week's blockbuster NVIDIA earnings report. The investor focus that's turning to the economic reports this week, especially Thursday's personal consumption expenditures report, the PCE. That's the Fed's preferred inflation gauge. Berkshire Hathaway, just talking about that. That's still climbing right now. Class B, well, they've actually just turned lower, down about 0.1%. Then the economic data this morning, sales of new homes in the U.S. edging higher in January. Purchases of new single-family homes increasing 1.5%. That works out to 661,000 on an annualized basis. S&P 500, 2 points higher, 5,091. We'll call that a record on an intraday basis. Right now, the Dow Jones Industrial Average up 57 points. That's up 0.2%. The NASDAQ 100, 46 points higher. That is up 0.25%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right. Thank you so much, John Tucker. Really appreciate it. I'm Alex Steele here with Paul Sweeney. You're listening to Bloomberg Intelligence, where we have all of our analysts cover 2,000 companies, 130 industries worldwide. We got you covered. We also got you covered when it comes to what do you do with your money. So I was out last week, and my big takeaway was that nothing actually changed. Stocks are definitely still going up. Everyone's really confused about it and scratching their head, yet no one's actually selling necessarily. Like, you cannot get a sell-off in this rally. Kathy Entwistle is Managing Director at Morgan Stanley Private Wealth Management, and she joins us now. Kathy, why won't markets go down?
That's a great question, Alex. You're always throwing those tricky ones at me. I would say basically that everyone is still enthusiastic about the opportunity of interest rates coming down eventually. So there was a little bit of a pullback a couple of weeks ago when we all realized that the Fed was not going to start cutting rates as soon as they had originally thought. But now we know they're going to cut eventually, so we want to get our money in and have a long-term view and get some of the growth that's been going on. A little bit of it's FOMO, a little bit of it is long-term thinking.
So, Kathy, we're pretty much through the earnings season here. I'm not sure I've seen earnings rise as much as the market has. So what did you take away from this earnings cycle here?
Yeah, we were expecting earnings to get hit somewhat because over the last year or so, companies have been still very positive with their expectations. And at some point, we're going to have to pull in because there are sales that are going down. The cost of goods is getting more expensive, and it's harder and harder to get that earnings number that they want in order to impress their shareholders. At the end of the day, there's only two ways to get the earnings to look good, and that's either to increase your sales and your revenue or to decrease your expenses. And a lot of companies are starting to decrease expenses. We're seeing that with the layoffs. And this is what we're thinking about of why companies are trying to reach those numbers by like making those cuts and laying people off. And it's not necessarily the most healthy way to meet numbers.
So, Kathy, what do you do then? Goldman Sachs had a note out that talked about how hedge funds are selling tech last week and they're buying consumer staples, for example. What do you do in this environment?
Yeah, one of the things that I'm doing with clients actually is a very simple, basic concept of asset allocation, right? Where you're starting with how much is the percentage you have in equities versus fixed income versus alternative investing. And I'm peeling back a little bit for those clients that have stayed in the markets and have done quite well. You can peel back a little bit from those names that have had a big run up and start going more into that whole fixed income arena because you are getting paid now for fixed income, which we haven't gotten paid in years for fixed income. So there's opportunities there. If the Fed does go ahead and reduce rates at some point in the future, there's a chance for a little bit of a pop-up too. So I think just looking at allocation is the first step. And the second step is looking at different areas of the market that we think will do well. We've liked consumer staples. We've liked, everyone has to buy toothpaste, right? Everybody's got to buy the basic products. So you can still go there. You can go healthcare. Healthcare should do well. We've seen some good numbers over this last earnings season too with healthcare, and we think we'll do, continue to do well there. And I think the financials still have a nice opportunity to recover in this market as well. So those are some of the areas that we're looking at.
Kathy, on the fixed income side, how much credit risk are you suggesting your clients take? Do you stick with the treasuries where you can still get very nice yields, or do you go out into the credit space and maybe take a little bit more risk for a little bit more return?
Well, that's a great question, and it's something I've been having a conversation with my clients about. I don't think if we're going to have, the Fed raise rates sometime this year, these higher short-term rates are going to eventually go away. And then it's going to be too late to lock into the longer, higher rates. So I've been slowly legging clients out of these short-term rates, the treasury bills and things like that, and going a little bit longer. if it's a taxable account and they're in a higher tax bracket, we're looking at municipal bonds. I really like municipal bonds for those clients.
So does Paul. So does Paul.
Yeah. Okay,
Exactly.
and Paul, great. So thanks, Alex. So the second piece of that is where are taxes going? They are definitely not going down. I don't know if they'll go up. Maybe they'll stay the same, but they are definitely not going down. The chances with a deficit and different things that are going on, we may see taxes at some point go up. It wasn't that many years ago or decades ago that we were in a much higher tax bracket in this country for the highest earners. And if that happens, municipals will be extremely valuable in your portfolio as well.
This is also sort of a basic but yet silly question. So when you're taking a look at your asset allocation, your barbells and all of that, what do you pay attention to? Like, is it when the earnings cross the tape? Is it going to be the PCE on Thursday? Is it going to be the Fed? Like, we all know where this is going, right? So do you just kind of like do your thing and check back in 6 months later?
I try, I do look at the different data that comes across, whether it's, PMI or housing starts or things like that. I think it's interesting that we're starting to see the numbers look a little bit more positive for home buyers, right? Mm-hmm. And it's probably because sometimes when people are waiting too long, it kind of compresses that demand up. So then eventually they have to start. I know a lot of investors are starting to think about purchasing because they just can't wait any longer. And there's also the idea that you can always refinance in a few years if rates do go down. So I think that you have to look at what your priorities are when it comes to your values and goals and how you want to live your life, and then try to find the best way possible to do that. In terms of looking at all these different numbers, when I think about clients, it's a little bit easier for me in the sense that we have a longer term view. We don't have a day-to-day. We're not traders. I don't have institutional clients. I have private wealth clients, individual clients, business owners, entrepreneurs, C-suite executives that are trying to figure out what to do with their money and how to make it, build and last. I've had conversations with a lot of clients in their late 50s. Their whole life, they've been in the accumulation phase, right? They're growing, they're adding money to their portfolio, and it's pretty low key. Now they're starting to think about retirement. And I can tell you, people get stressed when they start thinking about, oh, now I have to take this money and put I'm in the distribution phase. Like, how am I going to start using that money for the rest of my life? And it's a little scary, which is why I also think, clients can do a financial plan, which gives you a really great roadmap year to year about what kind of money will come into your portfolio and how to spend it throughout each year so that you have it for the rest of your life. So these are the longer term themes and topics I'm thinking about when I think about clients. And I'm also looking for, earlier people were talking about how, there's a strategy, Buffett takes a strategy of trying to find dislocations in the market. I've always thought that is the best way to think about clients' portfolios, their individual portfolios. Like, when is there a dislocation in the market and can we take advantage of that? So when we see the interest rates change favorably for individual investors and their yields are getting higher, that's a great time to say, we have a little money on the sidelines, let's start putting that to work.
Kathy, to what extent do you guide your clients into alternative investments, whether that's private equity, private credit, hedge funds? How does that work?
Yeah, absolutely. So, of course, alternative investments, you need to qualify for it. So you have to be like a certain level of investor. However, they're becoming more and more democratized and becoming more available to more investors than in the past. So the way I think about it is this. Equities, they've had a run. We had a 10-year, double-digit return. I think it was 2010 or so to 2020, something like that. We think alternatives are an area where we can see double-digit returns for the next 10 years. So we definitely want our clients in there. And so I'm looking at an asset allocation of anywhere on equities from 50 to 60. Now that fixed income is back in the game, we can peel back from the equities and add more to fixed income because we were kind of avoiding a fixed income for a larger portion of the portfolio in the last few years. So you've got 50 to 60% equities, maybe you've got 20 to 30% fixed income, and 15 to 20. You can go, depending on the size of the client's net worth, you can go as high as 30% in alternatives, but 15 to 20 is really a good number. And when we're looking at it, we're looking at trying to level up, sort of what the client is looking for versus their time frame, the liquidity needs, and all those things that need to be considered.
Really interesting.
Yep.
That's a lot, though, 15 to 20.
Yeah, that's what I hear. I mean, I hear that from the retailers.
It's very typical now. It's like, I would say that's what's typical for the, the high net worth investor.
All right, Kathy, thank you so much for joining us. Really appreciate that. As always, Kathy Entwistle, Managing Director, Morgan Stanley Private Wealth Management, joining us on a Zoom call from lovely Ridgewood in New Jersey. They love me in Ridgewood. That's a great town.
They love you everywhere in Jersey, don't they?
But I mean,
They let you into Ridgewood?
yeah, I know exactly. It was a very, I slipped in there. The country club, I've made it once. Ridgewood Country Club, lost many golf balls there. It's a great, great old course. Love it there. But we were at a remote for one of our RIA folks, registered investment advisors, and that's what the advisors were saying. They have a ton of demand from their clients for alternative investments. It's much higher than I thought.
Yeah, but it's like with Bitcoin. It's like, is it going to be 10% or 1%? And that really makes quite a big difference. Anyway, let's go to Michael Barr now for world and national news.
Alex, Paul, John, thank you very much. The White House is going to make an effort to try and get aid to Ukraine and avoid a government shutdown in a high-level meeting this week. Bloomberg's Ed Baxter has the story.
On the list of attendees, a number of key congressional leaders like House Speaker Mike Johnson, House Minority Leader Hakeem Jeffries, Senate leaders Chuck Schumer and Mitch McConnell. Now, the White House says Biden wants to discuss the urgency of passing the $60 billion request for U.S. emergency Ukraine aid, as well as the looming deadline to fund the government. Speaker Johnson's grasp on the speakership is tenuous. Part of his dilemma is he could lose it if he pushes for Ukraine aid without border. The meeting is set for tomorrow. Ed Baxter, Bloomberg Radio.
A 20-point loss in last weekend's primary in South Carolina has cost Nikki Haley a financial setback. A top donor, an organization backed by billionaire Charles Koch, says it will no longer donate to Haley. A spokesperson for the Political Action Committee says, "We don't believe any outside group can make a material difference to widen her path to victory." Meanwhile, Haley campaigned in Troy, Michigan, ahead of the state's Tuesday primary.
More of the same is not just Joe Biden. More of the same is also Donald Trump. You look at the fact that 70% of Americans have said they don't want Donald Trump or Joe Biden in this next election.
Haley is vowing to stay in the race at least until Super Tuesday. Republican National Committee Chairwoman Ronna McDaniel is leaving the party's top leadership role after weeks of pressure from former President Donald Trump. McDaniel, who has been at the helm of the RNC since 2017, said in a statement she will step down March 8th. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. The major stock averages. Right now, they're higher to little change as we enter a week of economic data. In the S&P 500, the number of stocks advancing and declining is just about evenly split right now. And the volume, a little lighter than usual. Palo Alto Networks among the leaders in the S&P 500 as well as the NASDAQ 100. It's up 7% after last week's plunge following its earnings report. Wednesday, we're going to get a reading on GDP. That's followed by Thursday's PCE, the Fed's preferred inflation measure. And economist Lindsay Pizzega at Stifel Nicholas sees a risk that inflation is just about to reaccelerate.
With the economy accelerating into the year end and the consumer still very resilient, it's not yet clear that the Fed has done enough to ensure that the U.S. economy gets back to a place of price stability.
Yeah, right now the S&P 500 unchanged at 5,089. The Dow Jones Industrial Average 60 points higher, 39,192. And the NASDAQ 100 39 points higher. That's a rise of 0.2%. Two-year yield, 2 basis points higher. The 10-year up 2 basis points. That's at 427. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Thank you so much, John Tucker. So I was away last week, and one thing that didn't change is that former President Donald Trump still grinds his way towards the GOP nomination, and there's continuous dysfunction in Washington and a potential shutdown this week and another shutdown next week. So shocker. I mean, I really wasn't surprised. Let's go to Nathan Dean. Let's see if he was surprised. Nathan Dean is Bloomberg Intelligence senior policy analyst. Nathan, I know it's lame, but I want to start on the shutdown risk. So partial shutdown risk for Friday, and March 8th would be a full shutdown. How worried do I need to be? I feel like I have shutdown fatigue.
So if you're sitting in New York and you're trading in the markets, you don't need to be worried all that much because scary headlines associated with market or shutdowns doesn't equate to scared markets. And we have not seen much of an impact even for the 35-day shutdown that we had under President Trump. You know, the S&P 500 had actually regained and was up prior to when the shutdown had started. Even if you're looking at defense contractors, if you're in that space, most of these defense contractors have their projects 18 months, 2 years down the line. So there's really not much of an impact per se for this shutdown. You know, if you're on the commodity space, you know, on March 1st, the Department of Agriculture is one of these agencies that will shut down. Some of those reports won't come out. The BLS reports are actually part of the second shutdown on March 8th. So a lot of the data that traders use could be delayed, but ultimately shutdowns really aren't a thing for New York and traders. It's mostly, you know, a lot of headline risk and questions about uncertainty.
All right, so let's assume something happens with the shutdown story, that they figure out some way to keep things going here. How about the big piece of legislation, which is kind of this aid to Ukraine and to others tied to immigration? Where are we on just kind of getting some legislation done?
Yeah, so I don't think that's going to come up in the shutdown debate this week. Look, the House doesn't come back until Wednesday, and they have till Friday night to figure out a solution. Even if they don't, let's just say that there is a partial shutdown going into next week, there's not enough time for the Ukraine aid to be a part of that. So I think what will happen is that sometime next week or either this week, they'll kick the can down the road, and they'll kick it to April. And then we have a deadline of April 30th. That is a 1% sequester if we are operating under a continuing resolution. I would anticipate the Ukraine discussions to come in at that point because nobody in Washington wants a sequester, especially one that impacts the Department of Defense. There has been talk about a discharge petition. This is a little wonky way for Democrats to try and force a vote in the House going over Speaker Johnson. I'm not putting much credence into that just because it takes a lot of time. The easier way for the Ukraine to go forward, and we are cautiously optimistic that it can get there, is that Senator Schumer includes it as part of a funding deal in April to avoid the sequester. We'll go through the same headline risk and the same, concerns over is the government going to actually do this or not. But ultimately, I think some form of funding can be found.
It's just amazing. It's just amazing to me. I know we all say this, but like if anyone ran their own budget like this, it would be a disaster. So this is what leads me then to former President Trump and his victory in South Carolina, and then the news that the Koch brothers super PAC will be no longer funding Nikki Haley, not because they hate her, but because they actually want to go fund people in Congress or in the Senate and the House of Representatives, because that's where they think they can make the most difference. How will this story play out?
So, obviously, I think the results from South Carolina prove that it is President Trump's nomination. This election, we like to joke, is between President Biden, President Trump, and people not voting. And ultimately, I think what we're telling our clients, and we're working with our clients, especially with non-U.S. investors on this, is, okay, at this point, we have many months until the election. Let's talk about the potential policies that could come out. Let's think about what President Trump would want to do if he becomes president, because on day one, he's going to implement a lot of executive orders. One of those could be the Inflation Reduction Act. There are a lot of tax incentives geared towards clean energy and toward the solar industry in there that could be delayed, discarded, and done away with, that ultimately could impact that sector quite a bit. So in terms of where we are and trying to think of what's going to happen with the election, once I think we get through Super Tuesday, I think markets and the general United States will just agree this is a race between President Biden and President Trump. We need to start thinking about, okay, what's going to happen if they become president, and the likelihood and the what-if scenarios of how does it impact your sector.
Yeah, that's interesting, Nathan. I mean, I can't imagine being a non-U.S. investor and trying to handicap just the political risk in the U.S. market. I mean, is there a way that people are kind of hedging here their positions, or do you just kind of wait and see how this thing plays out?
Well, I think a lot of it is also just trying to wait and see what play out, but a lot of it is what-if scenarios. So, generally presidents in the second term of their administration, and I'm just going to presume here that President Trump, this would be like a normal second term, is that presidents usually tend to lose their political capital after about 1 year to 18 months. Why would Congress want to stick their necks out for somebody in year 3 or year 4 when they're not going to be here? So presidents tend to move internationally and stay away from Congress and look across the ocean, per se, because the power of the presidency is a lot more powerful there when it comes to foreign policy, trade, and tariffs. So I think as traders, as you look through this, you're probably going to have about 1 year of domestic policy front where they're going to try and work with Congress to get things done. The second year is probably going to be a regulatory year. So if you're in the financial space, you'll have new leadership at the Fed and the OCC and the SEC and so forth. And then year 3 and year 4 is going to be more of a geopolitical macro year, because that's when the president sees, and we saw this under President Obama, we saw this President George W. Bush, they look outwards, and you're going to see a lot more negotiations, trade deals, and so forth like that.
Is there a realistic scenario where we go to the Republican convention and delegates just throw their votes to Nikki Haley?
Look, there's always a chance that there could be a no labels candidate, a third-party candidate, that Nikki Haley decides that she's going to run as an independent. There's always going to be a chance of that. But the general consensus, at least from the Washington folks that I work with and speak to, is that this is just going to be, once they go to the conventions, that they're going to give the votes to President Trump, and he's going to be the nominee. Because ultimately, I think a lot of the Republicans out there, and we're starting to see this in the Senate with their endorsement of President Trump, is, look, the idea here is that if he wins, we have 4 years, and then he's gone. If he loses, he's gone. So a lot of the Republicans out there say, look, we'll just throw our support to President Trump, and then we'll live the fight 4 years from now or, later next year.
If he loses, he's gone? I don't know why we think that.
Yeah, I don't know. As long as he still has access to any kind of social media, I'm sure he'd like to get his message out there. Nathan Dean, thank you so much for joining us. Nathan Dean, he's the senior policy analyst, Bloomberg Intelligence, joining us from our offices down in Washington, D.C., where I understand their food court is like the best. WTI.
It is. Did you know the Valentine's Day spread they had?
No.
They had a chocolate fountain and some fondue stuff, and I saw some pictures.
That's just like Washington spending, right? That's how.
There it is. That's why okay, now we know. Now we figure.
I mean, we have great stuff here, so I'm not complaining. Looking at the markets here, really not much happening here. S&P 500, I'm going to call that unchanged. Same for the Dow. We got the NASDAQ up about 0.2%. The VIX under 14, I'll call that out for Tom Keene. Yields slightly higher, 10-year Treasury 4.27%. Not much happening there. Call out WTI crude oil for Alex, up about $0.50 here, $77 for WTI crude oil. And Bitcoin, it's up 1.6%, 52,600 on the cryptocurrency. So getting some movement there. So we'll have to see. But the WTI crude oil, it's kind of sticky there. And gasoline, I'm paying like $3.15 a gallon That was a little north of what I did last time a couple weeks ago. So a little bit of inflation there in the gas tank. We're going to have more coming up. This is Bloomberg. Good morning.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the Bloomberg Newsroom with a look at some of the company stories we're following. Cashing in, members of the Walton family, and no, I'm not talking about John Boy. They sold roughly $1.5 billion worth of Walmart stock at the end of last week as the shares hovered near a record high. The Walton Family Holdings Trust sold 8.82 million shares, this according to the SEC from the filings, the notifications filed on behalf of Alice, Jim, and Rob Walton. Walmart has climbed about 11% this year, outperforming the 3% advance in the S&P 500 Retail Select Industry Index. Citigroup poaching. They've hired J.P. Morgan's Vishwa Raghavan as head of banking and executive vice chair as CEO Jane Fraser presses ahead with the bank's biggest restructuring in decades. In the new role, Raghavan will run one of the bank's 5 core businesses responsible for investment, corporate, and commercial banking. And we've been talking about Berkshire. The pile of cash that Warren Buffett's Berkshire Hathaway is sitting on has hit a record. Buffett can't find any attractive deals out there, apparently, so the cash at Berkshire keeps growing. In the fourth quarter, it was $167.6 billion. In the annual shareholder letter, the 93-year-old Buffett says there remain only a handful of companies in this country capable of truly moving the needle at Berkshire, and they've been endlessly picked over. The company has also struggled to find many of the big-ticket deals that burnish Buffett's reputation, despite ramping up the acquisition machine at Berkshire Hathaway. And finally, Domino's Pizza delivering sharp gains for its shares after they logged a profit beat for the latest quarter. I'm John Tucker.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Monday morning, everybody. I'm Alex Steele alongside Paul Sweeney. You're listening to Bloomberg Intelligence. We give you all the analysts, all the data from our amazing crew right here at Bloomberg. For now, let's get to Michael Barr, though, with world and national news.
Alex, Paul, John, thank you very much. The president, Joe Biden, will convene the top 4 congressional leaders at the White House tomorrow to discuss the emergency aid package for Ukraine and Israel. Biden is also calling for avoiding a government shutdown next month. Bloomberg News senior editor Bill Ferry says without an agreement on foreign aid, the U.S. government is at risk of a shutdown.
You've got this. It's let's say about half a dozen agencies that are involved that would run out of funding this week, and then additional a whole nother slew of departments that would face the same fate just a week from now. So those talks have always been contentious. This is, I think, I'll probably get this wrong, but it's at least the 3rd extension on the budget for these agencies.
Bloomberg's Bill Ferries. Ukrainian President Volodymyr Zelensky says that 31,000 Ukrainian soldiers have been killed in action in the 2 years since Russia launched its full-scale invasion. Zelensky says that despite the current stalled aid package in Congress, he believes the U.S. will ultimately come through with badly needed ammunition.
I think that the guys will decide, will make good decision for us.
Zelensky spoke while answering reporters' questions at the Ukraine Year 24 Forum in Kyiv. It's a financial blow to the sole remaining Donald Trump challenger. The Charles Koch-backed Americans for Prosperity Action will cut off funding for Nikki Haley's presidential campaign. After clashes with former President Trump, the chair of the Republican National Committee, Ronna McDaniel, stepped down on March 8th. With 2 weeks until the Oscars, Oppenheimer may be unstoppable. The movie about the atomic bomb won top prizes at both the Producers and Screen Actors Guild Awards over the weekend. The movie also won Golden Globes and Critics' Choice Awards. Global news 24 hours a day and whenever you want it. With Bloomberg News Now, I'm Michael Barr. This is Bloomberg. Paul, Alex, John?
I still prefer Barbie. That's all I'm saying.
Wow.
I've seen both.
Oh, wait,
I'm just
who's
saying.
hosting the Oscars? I'm sorry.
I have no idea.
Really?
Yeah. Why would I know that?
That wasn't really. I was looking at you, but
I think it's Jimmy Kimmel. I think he's.
Oh, okay.
Oh,
Safe bet.
yeah.
Are you coming to my Oscar party? Serving.
Well,
brie,
I've
Chardonnay?
got to be at my wife's Oscar party, serving beer and everybody who's enjoying it. That's root beer, baby. Don't worry.
And John Tucker's Oscar party will start at like 3 p.m. and end at 5.
Yes, everybody
Even
out of
before it happens. I got to go to bed.
3:05.
Okay, so Paul was just complaining about gas prices.
Yep.
Fair enough. Here's our 3 fun articles that I just feel like encapsulates the EV issue, right? Because one solution is if you have high gas prices, go buy an EV. First off, Renault is finally launching a lower end, and I say lower end, cheaper EV. It costs you $27,000, Renault 5e Tech, the first car to roll off its new EV platform that's trying to cut costs. On the flip side, you have GM dying to get into Europe in the higher end market and wants to pair up with some luxury names in Europe to do so. And then you have BYD that's basically flooding the market with cheap EVs, ramping up, and they unveiled an EV supercar that'll run you $233,000.
Yeah.
Tempted? Any of these?
No. Here's the real question for me, at least, just for EVs, is, to the extent that there's a weakening demand, why? Is it simply price? And if you bring the price down, will that drive the market, drive demand? I don't know.
Too expensive, and where do you charge it?
Yes,
I mean, I
it's
know
both.
there are charging stations out there, but am I going to stop?
And supposedly they're building out. Let's assume that they build out the infrastructure for charging, and let's assume prices come down. Is that enough or is there something more at play here? People just don't want to go.
No, I mean, I think that they do. They just that the hybrid is a bridge that no one thought was going to last as long as it was, and then Toyota wound up getting into that and got a lot of heat, and now it looks like that was the right way to go. My favorite part of the story, though, is Renault's quote-unquote cheaper car. It does come with a wicker basket for baguettes.
Oh, good.
So if you're looking for that,
Yes, it is a French car.
Ray, no.
Ah, oui, oui.
Does it go on strike a lot?
Oh, no.
Oh, nice.
Maybe when you can't get it. I don't know.
And it doesn't work the month of August.
It's true. You shut it down. This is...
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in on the Amazon story. It's now part of the Dow Jones Industrial. So let's get the latest on Amazon and its growth strategies. We'll do that with Poonam Goyal. She covers all the retailers for Bloomberg News. And then Jennifer Reed, Bloomberg Intelligence Senior Antitrust Analyst. There's a lot of deals out there that are facing antitrust review. Most recently, big deal in the financial services, Capital One bid for Discover Card. So we're going to get the rundown on all these deals when any of them get regulatory approval. And then Sean O'Hara, president of Pacer ETFs, joins the show to talk about ETF investing and kind of where the flows are going. So that's what's coming up this hour. Lots of stuff. Let's kick it off, Mr. John Tucker.
All right, not a lot of movement right now. S&P 500 poll on Alex, a little changed. And hanging out in record territory. You have 7 of the 11 major industry groups lower right now. Utilities, the biggest drag. Energy, that is the best performing sector right now in the index. And then you have Palo Alto Networks and Domino's Pizza, some of the leading stocks right now. This is a week chock full of economic data. The big one on Thursday with the Fed's preferred inflation measure. And meantime, Jim Bianco at Bianco Research isn't ruling out another rate hike from the Fed this year, but he says it's probably unlikely.
No, I don't think that we're right yet at the point that they have to hike rates. I was kind of in the 0 to 2 cut camp at the beginning of the year, and I'm more closer to the 0 camp, no cuts, for right now. I think that higher for longer is good enough.
Right now, the S&P 500, 3 points lower, 5,085 on the index. The Dow Jones Industrial Average, 18 points higher, 39,147. The NASDAQ 100, 37 points higher. That is up 0.2%. 2-year yield, 2 basis points higher. That's at 471. The 10-year, 2 basis points higher. That's at 427. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right. Thank you so much, John Tucker. Nice to see you, by the way.
You have no choice. You're in the same room with me.
See, he was out of the game last week. He
were
was
just
sick
alone.
Again. Yeah,
you were
it was just all
This
me.
has not been a good start of the year for me.
Sorry.
It's like I've been benched any number of times.
I took the under last week, but he pulled through.
He pulled through. All right, well, that's good.
It's betting against my...
The demise
let's
of
not
John
go
Tucker.
there.
All right, what's happening in the markets? As John was just saying, not a whole lot at the index level. Let's look under the hood. Nora Melinda, she covers all the markets for Bloomberg News. Nora, what are you looking at?
Let's kick things off here with Moderna. That's ticker mRNA. Those shares are down as much as 4.8%. And this is all coming after HSBC cut its rating on the stock to sell from hold. And it's really just citing those uncertainties in regards to its revenue. An analyst over there said that we expect the COVID-19 vaccine transition to last throughout 2024, thus revenue uncertainty should linger. In some context here, we do know that Moderna has really been trying to transition to other things instead of just the COVID-19 vaccine here. So it's trying to transition into RSV, flu, different vaccines instead of just relying completely on the income that it gets from COVID-19.
Well, yeah, and Moderna, in essence, they were creating an mRNA vaccine for cancer.
Right.
Like that's when they were doing a lot of work, and they happened to then pivot and then go to COVID.
That's right.
So they definitely still have other stuff in the pipeline. They're working on it. It's just a matter of sort of when that's going to wind up taking off.
Exactly. So those shares are essentially just lower off of HSBC saying that they don't know how quickly they can make this transition.
Yeah. All right, Berkshire Hathaway?
Yeah, so I mean, of course, this is lower than when we spoke earlier this morning, but nonetheless, this company has really been in focus. Looking at those Class B shares, those shares are down about 0.4% here, and this is actually after the company had opened higher at a record high here. And so it's really interesting as we're seeing this big conglomerate company almost pushing toward the $1 trillion value mark, but now sliding here as investors get a little bit apprehensive.
I don't see how you analyze that company. I guess like as Matt Palazzolo was on from BI, I guess just some of the parts. I mean, so many different businesses, railroads, insurance.
He's the insurance analyst.
Yes.
I mean, he's talking railroads. Yeah. I don't get it.
Dairy Queen. What multiple do you put on Dairy Queen?
I didn't know that it was Dairy Queen in there too. The DQ?
Yeah. Yes, and what's the taffy? What's chocolate?
Laffy Taffy?
I don't know.
Hershey's.
No,
Hershey's?
it's See's Candies. Se's Candies.
See's.
Yeah. So
Oh my gosh.
That was one of the original investments, I think, back in the day.
Wow.
But buying a railroad, that was pretty cool.
Dairy Queen. I'm getting hungry right now.
Yeah, exactly.
Is there one around? There's not one around here. Is
No.
They're around.
No. Where? In the city?
No, out in Jersey, in the swamps.
Everything's in Jersey.
Gotta go to the
exactly.
suburbs.
There you
Exactly.
go. All right, you got Alphabet there too. What are you looking at for Alphabet?
Yes, those shares are falling as almost 3% here. This is all coming amid concerns about its position in generative AI and the risks to its search business. And of course, the competition that I've seen from a lot of AI competitors. When I think about the tech space and AI, I'm really just feeling like it's a boxing ring here, and everyone's just trying to see who can make it to the top. But Alphabet has had a few missteps. Like last week, it had a pause of its image generation for its Gemini AI model, which everyone's really been focusing on. And analysts are saying that this is creating a perception that Google could be an unreliable source when it comes to AI.
You know, I do, by mistake, hit that Gemini button when I go to Google on the app, and it asks me if I want to get started. Hi, I'm Gemini. Chat with me on your phone to supercharge your ideas. I can help you write, plan, learn, and more. I've yet to do it. Do you use Gemini?
No, I've actually never used Gemini.
But you're the demo.
I know.
Yeah, I know. We're definitely not over here.
I don't really have an interest. I don't know. But I mean, I guess also I don't really use ChatGPT, any of those things yet. So I need to do some exploration here.
Well, I remember when ChatGPT came out on Bing, right?
Mm-hmm.
Matt Miller was all over. He says it was the greatest thing ever.
Because he thinks he's 20.
He thinks he's 20, and he's not.
I think that's the distinction.
Exactly.
Whereas we know we're not.
Right. So, but he swore by it. But that is a. I mean, I'm looking at the shares of Google here, flat year to date, no performance. Now they're up 50% over the last 12 months. So I don't want to go crazy. But if you think AI can do some of the things that the AI folks say it can do, search has got to be one of them. I would think.
It's just a matter of the ad spend. Like
Yep.
you got to show it to get the ad revenue at the end of the day, right? So if they weren't dependent on ad revenue, maybe it would be a different story.
Right, but kind of what I've learned is, the advertisers will follow wherever the audience goes.
Right.
So we'll have to see how that plays out. But very interesting there for Alphabet. Again, stock up 56% on a trailing 12 basis, but flat here year to date for Google. Nora, thanks so much for joining us. Nora Melinda covers all of the markets for us for Bloomberg News. Amazon, that's another big name. Now, that is now in the Dow Jones Industrials. Good for them. That's a big day for them. But the question is kind of where do we go from here? What are the drivers here for our good friends at Amazon? Because they are the biggest play on retail, but they're also one of the big plays on the cloud and all that kind of stuff. So Poonam Goyal, it's her job to figure all that stuff out. She's the senior analyst covering all the retail stuff for Bloomberg Intelligence. Poonam, if you go talk to your clients out there, your institutional investor clients, what's kind of the play on Amazon? Is it just shut up, I got to own it? Or I own it only for the cloud? Or what's kind of the story behind the Amazon play right now?
Yeah, I think it's all about profits. For a long time, Amazon was all about market share, and today the story is really a profit story. It's the profitability that's about to unfold at Amazon that's really getting people excited and interested. We wrote about this a few months ago where, if you look at their most lucrative businesses, and everyone knows of the cloud, which generates 30% EBIT margins, which we think can go to 40%. That could be a $200 billion business. So you're looking at $60 to $80 billion in profits in the coming years. But then if you add advertising to that, and Paul, the space well, they have 50% EBIT margins, and we can see advertising growing to $100 billion in just a few years. So you're talking about $50 billion in advertising plus if you add another 60, 70 of cloud, you're talking a big profit number here. And I think that's what's getting people excited. Aside from that, retail is growing. And part of the reason that advertising is doing so well is because you talked about search a little earlier. You know, people go into Amazon as if it was a search engine, right? You go in and you search for something. But the difference with Amazon versus a search engine is you go with a purchase intent. People go into Amazon looking for something and to click that buy button. They already know they want it. They just want to find it and get it there in 2 days or less.
That is such a good point. And this is a great example of this story of Amazon replacing Walgreens. So I was talking to an anchor who's been struggling with feeling sick and feels like that winter, like she's just sick all the time. And I was telling her about Airborne, which you take if you feel a coming on of a cold. She's like, oh, where do I buy it? Amazon. And I'm like, no, go to your local drugstore. It's 2 blocks away. But that idea, right, that like walking those 2 blocks isn't going to happen and I have to go to Amazon to buy the thing because it'll come in 2 days and I'm not even worried about it. Where is the downside, though, Poonam? I mean, you laid out a pretty convincing case. So how do I don't know, what do I worry about?
So I think, you know, the downside, if we enter a consumer recession, clearly Amazon will be impacted, right? So will the rest of retail. But I think that's near term. And as we've seen in past cycles, what goes down comes up eventually. Amazon is one of those places where we think if you view it for the longer term, there's just a lot of opportunity across all its businesses. We can't control the macro, but with their logistics platform in place, and even this example that you gave, you know, you need cold medicine or you need anything and you have to go to CVS or somewhere else because you need it now. You can't wait 6 hours, 12 hours, 24 hours for it. But I'll tell you that Amazon's delivery has gotten much faster. I mean, I'm seeing stuff at my door that I ordered today in less than 24 hours, sometimes 8 to 12 hours. And that's pretty incredible. And that's really a part due to their realignment of their distribution centers, which they're able to infuse an even faster delivery.
See, now I have a general idea where Poonam and her family live. It's literally amongst, or very close to, like, I think all these distribution centers in Central Jersey. It's unbelievable. I think we've got to be like the central, we have to be like the distribution hub of the East Coast, it seems like.
You're like a Jersey promo.
Oh,
You're
yeah,
like a walking
I am.
Jersey
I
promo,
am.
just so we're clear.
When I see the Gov, I tell them, you know. Poonam, let's back away from Amazon. Talk to us about just retail in general here. How's the consumer doing out there? What are you hearing from your companies?
I think the consumer is very focused on value today. If you're seeing the retailers that are actually being able to drive the share gains, you'll see that they offer some sort of value in their proposition, whether it was from Walmart that you heard from earlier, you know, that's doing well. But then we hear from the other retailers, the more discretionary ones, and they're struggling. Even the athleisure companies, we heard, you know, from Puma and Adidas, we heard from some of the other companies where they may have done well in 4Q because holiday was really strong last year. But when they look out for their guidance, it's been conservative for the most part from most of the retailers that I've heard from. And I think that just goes to show you that you have to have what the consumer wants and you have to have it at the price that the consumer wants it at for you to actually succeed in today's environment.
Macy's comes out tomorrow. We have to wait for next week for like Kohl's and Target and all those guys. But Macy's comes out tomorrow. I mean, that's a fine line to walk for Macy's. What are you expecting?
Yeah, I think holiday was really, really strong last year. So I think when these companies report 4Q results, you will see some reflection of that, even across the department stores. But the question is really, once again, on the longer term, right? Where do they stand in the longer term? Is this a viable business model? How many stores should they have? How
did we lose you?
Kind of grappling with right now. And we are in an environment where the consumer is spending on needs over wants. And if it is on wants, they're traveling. That's where they're going.
Yep. So we talk about inflation, Poonam. Prices by and large in the supermarket don't come down after they shot up however many percent here. That's just the inflation rate of growth is slowing. How about for like Adidas? Did they ever cut the price of a shoe because inflation's declining? Does that ever happen?
No, they add discounts, right? So if you want to bring prices down, retailers use discounts as a medium to do that. But once prices go up, they don't come down.
See, that's a problem with inflation. Yeah. That's why inflation is insidious.
Yeah. But so to kind of Paul's question, but really to my question, are we going to see a lot of discounting from retailers? So I don't know if you guys know this. Have we talked about Alex as a counter indicator?
No.
I only shop on sale.
Okay.
So where I'm shopping, you should be shorting the stock. So this is the joke that winds up happening because I'm shopping there because their inventory is bloated and because the sales are so good. So am I going to be going to Bloomie's in the next couple weeks, or are they finally have their pricing power and inventory in check?
I think inventory is getting more in check as we move into the spring.
Darn.
So I was in stores actually on Friday, and the discounts were pretty reasonable. They weren't too aggressive. There were some clearance racks across the mall, but I can tell you the stores were quiet. There was no one in there on a Friday afternoon. It was very, very quiet. So it's just interesting because there's new inventory that's flown in for the spring, and as stores put this new inventory out, they're going to be a little careful with their discounting, and we could see more discounts come in April on the spring inventory, but for now they're being steady and careful with them.
Well, I bought a new sport coat over the weekend, and maybe I'll break it out for you guys on Friday. Something to look forward to.
Okay.
How about
We can't
that?
wait.
Can't wait.
This is the long sell. This is sort of a
Did you get it on Amazon?
DTs. I actually walked into a local retailer, shopping local. That's how you go. Because guess what? The Brooks Brothers in the Shrewsbury Mall, done,
Oh,
closed.
no kidding.
Yes.
Actually, I've been there any number of times.
I
That's
know.
disappointing.
Crushing blow. Crushing blow. So, Poonam, what's the...
men's clothes.
Is there a fashion thing out there that's moving the market, moving the needle, that's maybe getting one of your names kind of outperforming the others?
I think across fashion, it's the same trend that we've been seeing. You know, denim is still in terms of athleisure. People are dressing down still, but their wardrobes are more balanced. I think we're seeing a little bit more of the work attire come back into play since people are returning to work in a more normal fashion. So we will start to see the career part of the businesses probably outperform this year.
That's really interesting. Who's set to benefit from something like that?
I'd say the department stores, really any Amazon, any of the retailers that have a more formal offering, and not to say suits, right? You don't need to be wearing suits to work anymore, but you do need to come out of your comfort wear, whether it's joggers or leggings, and really put on some dresses or some slacks to get into the workplace.
John, take off those athleisure pants, okay? You're
No,
supposed
this
to be
just
wearing
reminds
something
me of
different.
the fashion police Paul over here, yelling at some guy who was like wearing gym shorts in the office.
Well, the one, the sandals is almost a
that'll
game
drive me
changer.
crazy.
That could have been, I'm taking your lanyard and your badge and
Keep your
enough.
toes in your shoes.
Yes, exactly.
Toes in your shoes.
I mean, I'll sit there on the 6th floor on some of these days and check people out and give them some advice. Poonam Goyal, thanks so much for joining us. Poonam Goyal, Senior Retail Analyst for Bloomberg Intelligence. She was joining us via Zoom from the Princeton, New Jersey headquarters of Bloomberg Intelligence, even though we fought for years to get it to New York.
Okay, here's a retail question for you, sort of trivia question.
Ooh, I like
This
it.
building in which we are working, 731 Lexington Avenue, takes up the entire block, which is enormous in New York City. Which retailer did we replace here? They tore it down to build this enormous building.
Really?
Do you remember?
Can you give hints?
It's
Neiman Marcus?
No, it's no longer around.
No, I know. It's one of those.
Ken?
Is it?
Ken Fellew, global technical producer, got it right. Alexander's Department Store.
Oh, I would not have guessed that one. Okay.
That's going way back. And it's sat vacant for years and years
This
and
one?
years. Yeah.
No kidding.
It was amazing.
Because now we take over everything, and now we're spilling out all over Midtown Manhattan for other buildings.
Yeah.
Which
we need more space.
Yeah.
Which is kind of the whole point, right?
Yeah.
Retail, go online. Therefore, this is the way to go.
All right.
I love this conversation. All right,
S&P
what
500
comes
flat.
up? You take it.
All right, S&P 500, we're flat. This is Bloomberg.
action lost.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Well, after NVIDIA's blockbuster earnings report last week, fueling records, investors turning their attention to Thursday's PCE, the Fed's preferred inflation gauge. New home sales, got those numbers this morning. Those sales edged higher in January. New home sales starting the new year with a 1.5% gain. Builders and buyers apparently capitalizing on lower mortgage rates last month. Right now, the S&P 500, well, 4 points lower. That's down about 0.1%, 5,084 on the index. The Dow Jones Industrial Average up 19 points at 39,149. And the NASDAQ 100 right now 33 points higher. That is up 0.2%. As far as treasuries, the 2-year yield still 2 basis points higher. That's at 471, and the 10-year is up 3 basis points now. That's at 427. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Allison Paul.
All right, thank you so much, John Tucker. Really appreciate it. We just had a headline crossing, and this is according to Semaphore, that the FTC is going to sue to block the Kroger-Albertsons merger today. And this comes across as a ton of M&A has taken place in many different industries, and a lot of them going up against the DOJ. Capital One Discover last week, there's been a ton of oil mergers as well, so there's literally no one else to talk to but Jennifer Rhee. She's Senior Litigation Analyst at Bloomberg Intelligence. In my mind, the best person on this topic, pretty much out there on the street.
Oh, yeah.
For sure. Hey, Jen, there's a lot to kind of get through right now, but in terms of, say, Capital One and Discover, what's your prediction here?
Well, this one is such a tough one. You know, I think that the Department of Justice is kind of in a conundrum with this one, right? Because they're under a directive to get tougher on deals, and in particular, get tougher on bank deals. I mean, this is come from back in 2021 when President Biden issued an executive order saying, look, you know, we can't just rubber stamp these bank deals. We've got these huge banks. We've had problems with banking, and we need to get more aggressive. And the Department of Justice is on board with that. You know, we've heard their statement saying that they're on board with that. But you also have a market that simply hasn't been competitive for many, many, many years, and that's in credit card processing, right? We really have just two biggies, Visa and MasterCard. And this deal provides an opportunity to really bolster competition in an area that's been problematic ever since I can remember. When I started antitrust, the very first lawsuit I worked on was the Department of Justice versus Visa and MasterCard, alleging that they were engaging in conduct that was blocking out Discover and American Express. And ever since then, right, we've had allegations of or private litigation, public litigation against those two companies for antitrust violations, and we've had regulation. So this is this deal does have these strong pro-competitive benefits, but you've also seen massive political reaction against it. So you really have two very strong opposing sides, and I think it's just going to come down to the investigation and how the Department of Justice views the credit card issuing market and the overlaps in the credit card issuing market between these two companies, and how it weighs out any potential for harm it might find against this pro-competitive aspect.
So, but it seems like a reasonable argument that putting Capital One and Discover together does in fact create a viable competitor to Visa, MasterCard. Otherwise, there will never be a viable competitor.
Exactly.
Yeah, no, that's exactly right. And that's why this is an unusual deal because, all companies with deals come in and say, oh, there are all sorts of pro-competitive benefits that are going to benefit consumers and innovation, et cetera. And usually, sometimes they're kind of lawyer created. Sometimes they're really, it's unclear whether they're going to come to fruition. And most of the time, the Department of Justice or Federal Trade Commission are going to be very skeptical about those claims. They say they don't really ever bear fruit. But in this case, it's a much stronger claim, and it is kind of obvious to see how there really truly could be a very significant pro-competitive benefit here. And so it could be one of these unique deals where that aspect is given more weight than usual by the Department of Justice and possibly be considered important enough to allow the deal to go through, even if there might be some other issues.
Jen, couldn't I have made the same argument with, say, Spirit and JetBlue, and that definitely didn't work out?
It's so interesting you bring that up because I see so many parallels between that case and this case, even though completely different industries, because there was a very strong argument that those two combined could have bolstered competition against the legacy airlines, Delta, United, et cetera. But the problem there was that there was a small set of consumers that really depended on the unbundled low fares that were offered by Spirit, and we're going to lose out where JetBlue took over those routes and retrofitted the planes and created more space but raised fares. In a weird way, you kind of have the same dynamic here. You can create a lot more competition as against the incumbents, the big legacies, Visa and MasterCard, but you might have some sort of a negative effect on underserved consumers because Capital One and Discover, when they issue credit, they tend to focus more on underserved populations than do some of the other big issuers of credit. So people who are new to credit, people who carry a revolving balance, subprime borrowers. And it may be that there's a view that this impacts a smaller group of subprime borrowers. And in JetBlue and Spirit, at the end of the day, that won out. The DOJ won because of that harmful impact on a small set of particular consumers. You have the same thing here. But what you might have here is a stronger argument on the pro-competitive side than you had in that case.
Well, how about as Alex was just reporting here, the FTC to sue to block Kroger-Albertsons merger today, that's according to Semaphore. Isn't that an easy fix? We just sell some stores where they overlap?
That part of it is the easy fix, but remedies have two pieces. It's what are you going to sell and who are you going to sell it to? And both of those pieces have to pass muster. So I think on the what are you going to sell, that's probably an easy fix because ultimately the companies, if they can squabble over 20 stores or so, but if they can sell them, if they have to sell them. The issue here, I think, is going to be all about the buyer. This is CNS Wholesale that is the proposed divestiture buyer of all the stores the companies plan to divest in order to get clearance. And it's just not really clear whether they're going to be able to take up to 650 stores and actually compete with those stores viably and keep those stores open and maintain competition in each of these regions where there's too much concentration by virtue of this deal. So I think in court, what this is really going to come down to is vetting that buyer. And the companies are going to have to produce a lot of evidence that that's a good buyer that's motivated to compete and motivated to keep these stores open. And they're going to have to convince the judge. And if they can convince the judge of that on the buyer side, I think the deal will get cleared. If they can't, then I think the FTC will win there.
Is there an argument to be made for some of these potential deals that are getting a hard time from the DOJ or FTC to kind of bide time till November 6th of this year?
Absolutely.
Run out the clock? Is this part of a strategy?
I mean, absolutely. And look at Capital One and Discover. They very well are probably going to bleed into the next administration, whether it's Democrat or Republican. There is no doubt, Alex. I mean, historically, Republican administrations have the reputation in the merger world of being more business friendly and also being far less skeptical of claims of efficiencies, giving them a lot more weight. And that's going to be important, as I mentioned in this deal. Right now, it's a little bit of a wild card. It used to be 10 years ago that whoever came in to run the FTC, if we had a Republican president, whoever got appointed as chair, the Republican majority there, and whoever came in on the DOJ side, were likely to be more business friendly. We're likely to look at efficiencies in a more friendly manner. Right now, though, that we have kind of two different kinds of Republicans. You have sort of a Josh Hawley type, and you guys may have seen in the news that he's already come out and complained about this deal, said the Department of Justice should block it. And then you kind of have the Joe Simons type, who was the chair of the FTC in the previous Trump administration. A little bit more traditional in the way we think of Republicans in the antitrust world. And so I think to some extent, it might depend on who you get at the DOJ. But I would still say that it ticks higher. The chances of getting cleared probably tick higher if we have a change in administrations next year.
So, Jen, do you think this current administration, the fact that it is tougher on consolidation on deals, has that had an impact on M&A activity? Or a lot of companies are saying that it's not worth it?
You know, Paul, it's been a really strange cycle in my mind. I think in the beginning, when deals started getting a lot of pushback and a lot of more lawsuits than were expected, it sort of slowed things down, right? I feel like there was a period last year where in M&A slowed down. And now I feel like it's really picking back up again. And so I think there might be two reasons that it's picking back up again a lot, at least from the antitrust side. One, as Alex mentioned, maybe at this point, if you file, you're going to bleed into the next administration. There might be some expectation it's going to change. It'll be easier to get it closed. But Paul, the other thing is that the agencies haven't been that successful in court. So I think there is sort of a feeling, hey, if you're willing to put in the time and the money and you're willing to litigate, you have a really solid chance of winning in court, even if you face this really hostile, aggressive FTC or DOJ. And I think that could also be contributing to more of these deals getting signed now as well.
Jen, we have like maybe a minute left, but what about energy? All the energy deals, any one of them not going to happen?
Yeah, you know what? I think my feeling, and I know it's surprising, my feeling on those is that they're all going to get done. I think that there are just reasons where if you look at those markets and you look at the Permian Basin and you look at the number of producers that are in the Permian Basin, which I think is going to be the area that's going to be of most concern, I think ultimately those deals get done. And mostly, Alex, I'm saying that because when I looked at the history of FTC action against these kinds of deals, I didn't see anything that far upstream. All of the divestitures, consent orders, attempts to block deals were all downstream and not upstream. And so that's the reason I think these deals get done.
This is our water cooler talk, by the way.
Yeah,
like when I see Jen upstairs, we're getting coffee. We're like, hey, man, let's talk about those oil deals, just so we're clear.
Are they going to get done? Jen Rhee, thanks so much for joining us. Jennifer Rhee, she is a senior litigation analyst for Bloomberg Intelligence, joining us via Zoom, and she is the go-to person on antitrust. And I tell you, institutional investors, her phone rings off the hook when there's a big deal being litigated because she has the goods here. With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, and John. Nikki Haley's campaign is taking a major funding hit. Bloomberg's Ed Baxter has the story.
This, of course, comes after her disappointing loss in South Carolina, and now the Charles Koch-backed Americans for Prosperity Action will cut funding. It has spent millions of dollars since the fall on advertising and voter outreach efforts, but it says now, given the challenges in the primary states ahead, well, it says it doesn't think it can make a substantial difference. The PAC says it will continue to endorse her, but will focus on funding where it can make a difference. Ed Baxter, Bloomberg Radio.
Israeli Prime Minister Benjamin Netanyahu says the military still plans to wage a major offensive in the southern border city of Rafah, even if a new hostage deal is struck. Michigan Congresswoman Debbie Dingell says invading Rafah would put Palestinian refugees at risk.
It would be outrageous for further innocent civilians to be killed. I know that the White House is working very closely with a number of other countries to make it clear that we cannot continue this loss of life.
Congressman Dingell spoke on CBS's Face the Nation, heard Sundays on Bloomberg. Sweden cleared the final obstacle to gaining NATO membership in a move that will solidify the alliance's grip over Northern Europe and the Baltic region. The approval by Hungary's parliament today came 21 months after the Nordic country submitted its membership bid jointly with Finland in response to Russia's invasion of Ukraine. An apology and credit from AT&T to customers affected by Thursday's network outage. AT&T says it is applying a credit of $5 to their accounts. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
Facts, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Major stock averages mixed to little change right now as we enter a week of economic data. In the S&P 500, 207 stocks were higher, 294 were lower. Amazon shares, quick look there, a little change as that stock enters the Dow Jones Industrial Average. Wednesday on the economic calendar, we're going to get reading on GDP. That's followed by the all-important PCE. We get that Thursday, and that, of course, is the Fed's preferred inflation gauge. Meantime, Michael Scholl of Marketfield Asset Management, he remains positive about risk assets.
The overall market is still okay. I think the economy is still okay. I think for the things I like about what's going on, particularly in global markets, I think we should be a little bit excited about Japan, which it's made its way to an all-time high. I thought Japan would make it to an all-time high, but I thought we'd be talking about it.
Not a lot of love for the Nikkei. S&P 500 right now, 3 points lower in terms of attention, down 0.1%, 5,085. The Dow Jones Industrial Average, 11 points higher. That's at 39,143. The NASDAQ 100 up 58 points. That is up 0.3%. And yields right now, the 2-year up 2 basis points. That's at 471. The 10-year, the benchmark up 3 basis points. That is at 428. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker studio. We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Podcast, and that's how you'll find us. Love talking ETFs, because that's where all the money's going. It's just an amazing, amazing development in financial services over the last 10 years or so to see how the funds have just really just gone into the ETFs, both passive and active. So it's why we like to check in with our next guest, Sean O'Hara, president of Pacer ETFs. Sean, thanks so much for joining us here. Talk to us about kind of where you're seeing the flows these days. Is everybody trying to chase the AI trade? Is it folks looking at tech? Where are you seeing kind of the flows these days?
Yeah, good morning. Thanks, guys, for having me. I think, it's still the same, as it was last year. I think that there's a real diverse spreading around, if you will, of the assets. Obviously, there's people, chasing tech. I don't think you necessarily need to chase tech. You could buy a broad market ETF like the S&P 500 and still get pretty good tech exposure, but not have all your eggs in that basket. Our flows continue to be leaning towards value. Small cap has been a real big surprise for us here lately. We do have the tech side of things. We've got a data and infrastructure product. So I think we're sort of where we were last year, which is a little bit puzzling to me, because last year, at least, we were coming off of really an obliteration in the tech names, but we're still stuck in the same place. We're looking at interest rates and what the Fed's going to do. We're trying to figure out whether they've actually done their job and destroyed the U.S. economy. I'm sorry, not destroyed the U.S. economy, but cooled things down inflation-wise. And then, earnings are always going to be the issue going forward. I'm not as impressed with people beating their earnings as I am in what they're forecasting is going to happen. Mm-hmm. And when you have these reports like you got out of Palo Alto last week, where they sort of tamper things down, I think we're at a level right now where the market's priced overall a little bit on the high end. And so, we have to be very, very careful about bad news.
I mean, you made the joke about destroying the economy, but man, that data continues to hold up really, really well. Is there a reactive sense to ETF flows, like big reversals that are happening? And I guess I'm just trying to understand where the biggest misprice is. If inflation kind of eventually keeps coming down and the data still stays okay.
That could be what happens, Alex. You could actually, they might not actually destroy the U.S. economy. They might do it perfectly, right? They may have gotten inflation under control without, having unemployment spike and without having a major impact on, everybody's earnings. I think the interesting thing that's happening right now is that, and I think you need to keep an eye on that, is look at layoffs. I mean, we're starting to see somewhat of an acceleration. So I think companies are starting to think to themselves going forward, how do I increase my earnings? Well, one way to do that would be on the cost side of the ledger. And so as we came out of COVID, that was the big spur that got the big tech names going, is they were over, weight, if you will, employees, and they started to cut back, and that's sort of what juiced their returns. And I think you're starting to see that go sort of a little bit more broadly across the board.
Hey, Sean, you say maybe one of the ways to play AI is through the picks and shovels strategy. Talk to us about how you'd get exposure that way.
Well, we have two strategies there. We own the data centers and the cell phone towers. And so you can't have AI streaming, or Internet of Things, e-commerce, and online gaming. You can't have that without the buildings that essentially allow for all of the transmission of the data. So that's one way to play it, would be to buy data centers and cell phone towers. We have an ETF that does that, the ticker's SRV, our server. And then the other way to do it is to play, if you will, the software names and the chip makers. And those names are, basically the NVIDIA is in that mix, but it's not all about NVIDIA. There are a lot of companies in that space. And so we have an ETF that TRFK, traffic, that basically takes everything out of the data centers and says that's what we own.
When you talk about alternatives, we were talking to Kathy Entwistle in the last hour about alternatives and stuff. We'll throw Bitcoin in there. Let's throw some REITs in there too. What other kind of alternative ETF flows are you seeing?
Well, we have an income story that we like that's starting to pick up some steam. Essentially, its target is to get 4 times the dividend of the S&P 500. And
4 times?
Okay. 4 times, yes. So the ticker's QDPO, get it, quadruple. And the way we do that, the way we do that is about 86% of the money is basically in the S&P 500 and 14% of it's in T-bills. And those T-bills are used to enter into futures contracts on the dividends. And so we're able to pull forward 3 times, or a little bit more than 3.14 times, this year's dividend by using those futures. And so it's really done exactly what we've expected it to do. And with all the emphasis, for example, on covered calls, with the success of some of the big players in that space, we think the limitation on covered calls is that you're selling away your upside. And with the strategy like this, you don't sell your upside away. So we're starting to see some interesting flows in that area as well.
Sean, how do you compete and set yourself apart?
We like to say innovative, disruptive, and unique. That's what we build. So our neighborhood home in Malvern, Pennsylvania is Vanguards. We know who they are, we know what they do, and we know that we're not ready to stand toe-to-toe with them, if you will, and fight it out on cost. We'll let State Street do that. So we build strategies. We build an end user in mind or an outcome in mind. Maybe that's excess return, or maybe that's risk management, or maybe it's something like the Count series that just takes a completely different look at the way you define value in this world. Instead of using traditional price to book, we use free cash flow yield, because the stock market is primarily intangible assets today. And so that's what we do. And so we've been able to accumulate, I think, a reasonable amount of assets, around 40 billion right now. I think there's a lot of room for us to grow. And, if you're innovative and you're disruptive and you're unique, and you have a sales force like we do that focuses on the financial advisors, you can continue to build a nice business. I don't have to have a $5 trillion business.
Yeah.
I just need to keep growing it like we have been, and we'll continue to do that, we hope.
I really want to have the job where you get to come up with the names for these things, like the tickers for it. I want to do that. That sounds like a good time. Before we let you go, it's not just U.S. that have been doing really well, right? Japanese equities, Nikkei, record high. The CAC, the DAX, record highs. What opportunities are you seeing internationally?
Well, we missed Japan. We probably should have had a product there, because whenever Warren Buffett starts to move in an area, it's probably good to pay attention. And so he's increasing his exposure there. So he's probably right. We've seen a pretty big increase in our global and international. My favorite story, and it may take patience, I'll just warn all the viewers and listeners, is emerging markets. I mean, we have an emerging market product that has like a 9% current dividend. And it's 100 profitable emerging market names. And I think that cycle has gone on too long. It could continue for a while, but sooner or later, the emerging market cycle will change. And if you think about historically how they do relative to U.S., over time they do better. It's just been a currency problem here lately. And so for long-term investors, maybe you tuck a little bit of money in emerging markets.
All right. Sean, great stuff. Really appreciate it. Sean O'Hara, president of Pacer ETFs, joins us. Really appreciate that on the ETF inflows, outflows, and where all the action is. How do you get that job as like the ticker ETF person?
You have to go
John Tucker. This feels like a question for John Tucker that he knows in the recesses of his brain.
It doesn't sound like it's a full-time job, though.
That's okay.
But I like cows, COWZ for cash cows.
Yeah, I mean.
And then they also have CAF, CALF for the small cap cash cows.
Really? Oh, but then you can also use it, beef if you wanted to do something for, prices of cattle or something like that.
Yeah. Options are limitless.
Literally. This is the good stuff. All right, we're going to have much more coming up for Bloomberg. You're looking at an S&P doing something. The S&P is pretty much flat on the day. Volume's also light on this Monday morning. This is Bloomberg.
your company news headlines on Bloomberg Radio.
And I'm John Tucker, in the newsroom. Look at some of the companies we're following. The Defense Department is joining the AI craze. The U.S. apparently used artificial intelligence to identify targets hit by airstrikes in the Middle East this month. This according to one defense official, revealing the growing military use of the technology for combat. Machine learning algorithms that can teach themselves to identify objects helped to narrow down the targets for more than 85 U.S. airstrikes on February 2nd. Procter & Gamble, Church & Dwight, and other consumer good lines could be impacted by a New York City council bill. It would ban the sale of laundry and dishwasher detergent pods that contain polyvinyl alcohol, PVA, as environmentally unfriendly, though that measure unlikely to advance this year based on comments from the bill's sponsor. Societe Generale SocGen extending the hours of a night shift team to prepare for the U.S., reducing the time to settle securities transactions to just 1 day. Financial institutions, including banks, brokers, and investment houses, now just 3 months to prepare for the U.S. switch to a faster settlement cycle in late May. We've had